we'll get started. Mike Doyle will be joining us on the television, we think. I texted him, so we'll pay attention to the text. We're expecting him, and Art Wallace called me yesterday and he's unable to attend. All right, we will call this regular meeting of the Board of Finance July meeting to order. All rise for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. We begin our meeting with public audience. We invite members of the public to come and speak for up to 3 minutes. There's Mike. Hi, Mike. Is there anyone who would like to speak at public? Joan.
I would love to talk.
Thank you. And just remember you're addressing the board, and if you could just state your address if you're willing, for it just makes it easier on the clerk.
It's very good. Insanity is doing the same thing over and over again and expecting different results. The Board of Finance should implement a priority-based budgeting approach to fund core services based on community impact. AI, artificial intelligence, should be used as a tool to increase efficiencies and lower costs. The town should be proactive, not reactive, to limit the increase in rental units with families that increase the use of the infrastructure, demands on the schools, natural resources, and public safety. The Board of Education has renovated Latimer Lane School and Henry James Junior High prematurely without any discussion on redistricting and placing the 6th grade in the junior high. Grades K to 2 should be placed in 2 schools. Grades 3 to 5 should be placed in 2 schools, reducing overhead costs. There should not be any proposal for school renovation until there is a complete impact study on increased enrollment. The high school track and field replacement was prioritized over the dismal, unsafe tennis and pickleball courts at Henry James Junior High that are used by the tennis teams for practice and the community for play. The Memorial Park pool and the entire facility should be removed, having all swim activities at Simsbury Farms. A $2 to $3 million splash pad is not a necessity when families can attach a garden hose to a sprinkler on hot days with no cost to the taxpayers. Families should take responsibility for their family's quality of life without asking the taxpayers to foot the bill. The new ACT building with 3,000 square feet of space at a cost between $2 to $3 million on the Simsbury Meadows for the sole purpose of the Simsbury Performing Arts should produce a quarterly report to the town of all expenditures attributed to the building maintenance as a special revenue fund. The Board of Education New Path building should have a special revenue fund for all revenues and costs associated with maintenance of the building. The Board of Finance acts as the primary fiscal watchdog and steward of public funds. It is the Board of Finance responsibility to ensure budgets that do not place an undue burden on the taxpayers by evaluating all expenditures on a cost-benefit analysis. All my comments will be posted on Simsbury Pat and Twitter at Joan Co. Thank you for listening.
Joan, you were under 3 minutes. Thank you.
I did it under the line.
You did. I'm impressed. Is there anyone else who would like to speak? Lori, come on up.
That show Price is Right. Come on down. I am Lori Boyko. I'd like to bring your attention to an issue I came across when analyzing our library expenditures recently. Currently, the library receives a generous additional nearly $100,000 in funding annually from the Friends of the Simsbury Public Library. That money funds everything from large print books and fish tank maintenance to summer reading and adult programming. The problem is that this funding is being funneled completely outside of the town's operating budget. Through public records requests, I confirmed that during fiscal year 2025, library staff regularly initiated municipal procurement actions under the town's name and tax ID. They signed vendor contracts, booked performers, and collected IRS W-9 forms. But instead of routing those bills through our standard accounts payable process, they handed the invoice to the Friends Group to pay them directly out of a private bank account. Our finance director has confirmed that $0 of this money flows through the town ledger or the library special revenue fund. I want to be really clear. There is no evidence or suspicion of fraud here. The staff and volunteers are well-meaning, and this was a generous donation, which goes on every year. This is strictly an issue of total financial transparency and municipal legal and accounting compliance. This town already allocates a very generous annual budget to our public library, but nearly $100,000 in additional spending covering recreational events, craft giveaways, specialized fabrication equipment, and private dance lessons is happening entirely off the books. By bypassing the town budget entirely, the town is exposed to serious regulatory liability. It creates IRS Form 1099 noncompliance because the town is legally responsible for reporting vendor payments over $600, but sometimes holds a ledger showing $0 spent. It violates GASB rules that mandate that material operating costs be recorded as in-kind revenues matched by expenditures. Library gift money must flow through the town treasury under Connecticut general statutes and be drawn down by the proper officers of the municipality. By avoiding the ledger, this board is flying blind during budget season, evaluating budget allowances based on a heavily deflated historical baseline. Taxpayers have no transparency or informed choice at the budget referendum because the accurate amount of spending is hidden. If a town department selects the vendor and dictates the purchase, it is a public procurement action. Shifting who signs the paper is just an administrative workaround to keep a massive chunk of public operations invisible. The library board has twice now voted to accept incorrect donation amounts from the Friends without an itemized municipal accounting. My review of the invoices paid by the Friends obtained via FOIA shows they are riddled with administrative errors, missing receipts, duplicate receipts, and cannot be mathematically reconciled with the board-approved total. I urge the Board of Finance to instruct the library to immediately halt direct third-party vendor payments and transition the library to a compliant, standard gift account model in which the Friends submit payment or donations through the library special revenue fund account as directed by state statute and as the state itself does. This will protect the town, safeguard the volunteer Friends group, and restore fiscal transparency.
Thank you, Lori. Is there anyone else who'd like to speak? Seeing none, we will close public audience. We have with us actually tonight our auditor, our principal auditor. So, and he will be giving a presentation for us at pre-audit, beginning the audit. We have with us David Flint, who is the audit principal, sometimes goes by the name of Dave. So, welcome, and why don't you tell us, we have two new members of the board and obviously members of the public, so a good review would be helpful.
Yeah, absolutely. Thanks for inviting me here tonight. My name is David Flint. I'm a principal with Clifton Larson Allen. For those of you that don't know, my firm specializes in serving municipalities. Specifically, we work with about 90 different municipalities in the state of Connecticut. I did provide to you with a letter. This is kind of a letter that we provide every year to kick off the audit. I'm going to be honest with you, this is the same letter that I provided with you last year. The real purpose of the letter is just kind of to facilitate discussion between you guys, who are those charged with governance, and of course the audit firm itself. I did kind of want to just take some time before we started and before maybe you guys had any questions, just to kind of highlight what we do on a high level. And there are three main things that you guys hire us to do. It's a state single audit, a federal single audit, and of course a financial statement audit. The state and the federal single audit, of course, are very specific audits over the grants that you receive from both the state and the federal government. Both the state and the federal government set the procedures that we do over each individual grant. They're small audit programs called compliance supplements that we follow, and they're specifically written for each grant. We provide reports that highlight all the expenditures, so not revenues received, actually expenditures. So you could receive a grant last year, you're not going to spend it till this year, or vice versa. We provide a report that records or provides all the expenditures for both the state and the federal grants. The primary thing that we're doing, of course, is the financial statement audit. A financial statement is the end result of that financial statement audit.
I'm sorry.
Sorry, I gotta go. And the primary purpose, or primarily what we're doing, is to make sure that those financial statements are free from any material misstatements. And we're doing that so you guys, as those charged with governance and any other users of the financial statements, can properly use them to run the town, right? And that's a very important aspect that I'm trying to make clear that is different than what a forensic audit might be. Obviously, with what's going on in the news and the state, this has been a huge discussion topic over the last couple of months. Whereas a forensic audit is designed to detect fraud, our audit is designed, obviously, to make sure those financial statements are free from any material misstatements. We do oftentimes find fraud when we're doing a financial statement audit, but it is not.
But not here.
But not here. But it is not designed to detect fraud. We will incorporate into our audit some unpredictable procedures that are often designed to detect fraud. These are unpredictable procedures that we change up every single year, just to keep the finance staff on their toes, if you will. But overall, big picture, again, we're just trying to make sure that the financial statements are free and clear from material misstatements. Our audit program, if you will, is based on risks. Every audit area is given a risk of low, medium, or high. And then based on what that risk assessment is how deep we'll dig into that each individual area. There's many areas within an audit, and they all have different areas from low, medium, or high. And oftentimes the control environment themselves and how well those controls are functioning and designed are what attributes to our assessment of low, medium, and high. So does that kind of make sense on what we do at a very high level?
One question.
Yeah.
So you mentioned the forensic. Can you talk about how that differs than a performance audit?
A performance audit, a forensic audit is very specific. Usually we're only called to do a forensic audit when fraud is suspected, right? So we're digging into specific expenditures, specific receipts. We're going line item by line item, looking at 100% of the population. In a financial statement audit, we're sampling. It would be very unreasonable for us to look at every single transaction over the course of the year. Though it took 365 days to record all those, it'd probably take similar to audit all those. So we're sampling based on a risk assessment, like I mentioned. A performance audit might be more broader. It might look at a larger area. It might look at the controls, procedures, and processes, and then of course the results. We don't necessarily care about the results. We just care that the results are recorded properly. For example, a question I get a lot is, our general fund has had deficits for 3 years in a row. How come this hasn't come up in the audit? The actual performance of the general fund is not something that we're looking at. We're just making sure that it's recorded properly so that you guys can make the financial decisions. So I hope that differentiation makes sense.
So I have a question in the corporate audits. If we were to see something like that, then the auditors would have a going concern issue and then make a statement about that. Is there a similar thing with municipal audits?
Yep. So yes, we do have to do going concern analysis for if we were to see a municipality that was really in dire straits. But a municipality itself, meaning a town or city, probably not going to go bankrupt. We see it more with a small quasi-governmental entity housing authority, small utility company, things like that. But that is something that we do have to do.
Okay.
Keep going.
So that's kind of what we do. The purpose of this letter is kind of just to facilitate conversation. So get me out here. Are there any questions or comments or concerns that you might have? Are there any areas that you think that need to be looked into deeper based on things that you've heard, based on things that have come up over the course of the year? I do highlight that we will be doing our final fieldwork in here. We'll be doing that in November. And then of course the due date for the audit is December 31st. One thing in here that does often come up is we do put significant risks for the audit, and listed in here is management override of controls. Everybody gets this significant risk. You could have the best controls written up, the best processes and procedures, but if management is overriding them, they're not effective. So this is a significant risk that's included in all of our audits. Now, if you had findings last year, findings that would have carried over into 2026, those would also be listed here as well. So I'll open it up to you guys if you guys have any questions, comments, or concerns related to the 2026 audit.
Do you wanna let them know that if there are any concerns, they don't have to say it here, you do fraud interviews one-on-one?
Absolutely. As part of the audit, we will do fraud interviews that gives the person being interviewed a chance to discuss any concerns that they might have. We try to mix them up every year with people who we interview, but we do always try to involve one person from the board. Obviously, Amy will be interviewed, and then we'll mix it up as other employees throughout the town as well.
If a board member wants to reach out to you, they can reach out to you directly.
Always, yes, my contact information is in the back of this letter. The line of communication should not just be day one when I'm here, and then when I'm presenting the results in January or February, whenever that is. My contact information is there, whether it's email or a phone call, always available to you guys.
I have a question on one of your bullet points here. Thank you for this. And I just quickly scanned over it. So with reference to the advice that you have over internal controls, so that's basically us, correct? Is that what you're when you mention internal control, who is the controlling authority? Would that be the Board of Finance oversight?
You guys are what's known as those charged with governance. So you're the end all be all, right? You're who hires us, you're who fires us. But internal controls is much more finite, right? There'll be internal control owners at all various levels of government, and we make sure that most importantly, every control has segregation of duties. Control is not functioning as designed if there's only one person involved. So we try to make sure that there's two people involved in every internal control.
Okay. And so when you're looking at internal controls, what is your guidance to the Board of Finance as to what we should be looking at?
To what you should be looking at?
Yeah.
I don't typically see a Board of Finance getting into that level of detail. What I would recommend to the Board of Finance is doing a fraud risk assessment. Is that something that you guys have heard of or have done?
We already did it.
You already did it.
And we actually have policies that Amy sent us today that we'll obviously ask her to forward to you that were just drafted. We haven't had a chance to look at them, but we did that in October. Was it
Yeah,
completed?
we did that last year, so you'll get that report when you guys come
Brownie
out.
points. Not too many.
Points, that's right.
Not have I recommended it when you guys have already done it before.
It
That's
was already on our
fantastic.
report for a while.
Yeah.
But to answer Lilisa's question, when they're looking at the internal controls, like they're looking at our day-to-day activities, like is somebody signing off at the bank rec? Is there 2 internal controls for wiring money, things of that nature? Your role in that is if we fail. He reports it out to you to let you know that there's a failure, and then it's your job to make sure management corrects it.
Thank you. And the other thing we do is we do policy work, but that's on a broader level. Mark just shared with us the disposition of asset policy. We appreciate that's really in the Board of Selectmen purview, but just knowing what that is helps us look for deviance, and you look for deviations on that. Mark is working on the take-home vehicle policy. Again, that's mostly in the Board of Selectmen purview because it's management, but we look at it because there are reporting requirements requirements there through the IRS, and if they aren't reported properly, then we are exposed to risk there because they have to report personal use of it, and it's kind of complicated. So we want to make sure that the town has proper processes and procedures in place and that they're reasonable, and that our auditor looks at those and confirms that they're reasonable, and then he checks to make sure that they're working as designed.
I think that last part is important, right? Not only are we reviewing the controls, we're also walking through the controls to make sure just because they're designed well doesn't actually mean they're happening as designed.
Right.
So we walk through examples to make sure that they're actually occurring
Okay.
as they should be.
Right, and I know that this is my last question, so I know that this is not a forensic audit, thank goodness, we never want that. But would those, those initial steps that would eventually could lead to a forensic audit, would that also be within the purview of a regular audit?
So if it's very possible that something could be identified in a financial statement audit that we would bring to your attention, and then you, as those charged with governance, would decide, hey, we really want to dig into this.
Okay.
We would like to have a forensic audit done over this area.
Got it, okay, thank you.
And I already forgotten what it's called, but right before the meeting I asked you put out a letter to board members of things to consider and forward in future years, just like the fraud audit letter.
Oh, our management letter?
Yeah, management letter. And because we have two members, I asked Dave to forward it to the whole board again, just so that it might have it'll probably go through you, Amy, if you please forward it to us.
That would
Thank
be
you.
fantastic, thank you.
And then
Just send
one
me
thing I
last
had
year's.
for you is if you think you're gonna be
Sending last
delayed,
year's? I can forward it.
if you think you're gonna be delayed in getting the audit done by December 30th, we ask you to come to report to us in person on that and explain the reasons.
That'd be great.
There was a big push from the PM. There were too many people not making the deadline.
Oh,
So-
it's yes.
So
I
we
agree.
wanna know early if we think that's gonna be an issue, because we use that obviously in our budget deliberations. And then one of the things we talk about constantly, and I don't know if this would be you or we would go to an outside agency, is if our board wanted to do periodic performance audits on different areas. We did one on the assessor's office, really helpful, helped us understand how to better resource it and staff it. Is that something you guys would do, and what sort of would we need a rider to the contract we do with you, obviously, and sort of how we would figure out what would be a reasonable amount to do those periodically?
So we have a group called our BRS group, Business Risk Services, Lindsay Intreri in our office. That's exactly what she does. Municipalities hire her to come in to review a specific area and make sure that the processes and procedures are adequate. She'll look at whether the staffing is adequate, things like that. And she'll provide a report based on that. That's all she does. She's really good at it. As far as a reasonable cost, that's certainly something we could talk about. You could certainly go out to RFP. I'd be happy to provide a quote on any area that you would be interested in. But that's certainly something that we get asked a lot.
And one of the things raised at public audience was the library board. One of the things we did our policy on transfers and how some of our reporting of funds goes. And one of the things I just want the public to know, the library board of trustees follows a different state statute, and there are different laws and procedures that apply to that. So obviously you look at that when you do your audit. Okay, I just want to confirm that. All right.
That's interesting, I didn't know that.
Yeah, no, it's a very different
landscape.
And as is so with many Connecticut regulations, it's not always clearly written. So we rely on expert for that interpretation, but I did want to let folks know there is a separate authorizing statute there for that, since it
Okay.
was raised. But thank you, appreciate those comments. All right, is there anything else? Anyone else? Mike, do you have anything?
No, Madam Chair, thank you.
Okay, thank you, thanks for coming in, and we look forward to
Appreciate it. Thank you so much.
your work.
Yeah, I will. Thanks.
Okay, before we get to the finance director's report, just a couple of quick follow-ups and new information. We have some late breaking news today. I got some information from Selectman Yaisley, the Aging and Disability Committee, and Mark and your staff. Worked to secure 5,000 North Central Area Agency on Aging Grant, NCAAA, for Super Thursday events. So I just wanted to congratulate everyone who worked on that.
Thank you, Chair.
So I wanna thank everyone who worked on that. That's a great, so congratulations on that. As we mentioned earlier, Mark circulated the take-home vehicle policy. I gave some feedback to him that he's working on.
Appreciate that, Chair, especially the input on the state policies. We're looking into that now, so we'll get another draft probably next week.
Just a question on that. Is it cheaper for the town to have the employees use the municipal cars when they go out of state versus something like a rental vehicle or things like that?
Typically it is, yes, not always, but 90% of the time I'd say it actually is cheaper to use the town vehicle.
Is there a list, like if you wanted a list of all of the current vehicles and which ones are available for general and who's got them?
Yep.
Like how long would it take you to have an updated list of that,
48 hours,
including the police department?
yes.
We have to report that actually to our audit, so
We
there
might
is
be
a-
missing some tractors and some heavy trucks that somehow don't get on the same spreadsheet, but we're working on that.
Do we have that list, Amy, in our Excel? Okay, so that's pretty easy. And Mark, do you keep track of like take-home vehicles in other comparable towns, how many they have?
It's a little bit more in other towns is what we've seen, just anecdotally. I think what you do is you take out public safety as police and then you look at everything else, and that's what we've done. And I think we're on par certainly with the other towns in the Farmington Valley and our peer communities. I don't think we've extended the privilege of take-home vehicles, more than our peer communities certainly. But it is an opportunity to take a look at it. It hasn't been looked at in a while, as you know. And there's been, as you mentioned, a lot of changes. So we're still trying to come to grips with a couple of pieces of this, and then I think we'll be ready to roll it out.
Okay, great.
Oh, and your comment too about we're gonna make an addition, and correct me if I've got this wrong, but where an employee who has the take-home vehicle privilege is gonna be out of town or on vacation for a while, that vehicle then will need to be parked back on town property for the duration of their departure or vacation or whatever. We're just looking at the language for that. So thank you for that recommendation. I thought that was quite good. You don't need a tree falling on our vehicle in their driving, in their parking lot
Or some other
Yeah,
secure
driveway
location or
or-
agreed upon secure location, but there should be a policy on what happens when someone's on vacation, wherever you
We're
end
gonna
up.
add that, yeah. Thank you, Chair.
Sure. Amy mentioned, with our auditor mentioned the fraud risk policies, those were circulated earlier today. So again, that was many months of work from you and your team. I think Kelsey worked on them as well, is that right, Amy? So please extend our thanks also to her for that, and we'll take a look at those over the next few days. We also received Amy's update on health reserves. As for members of the public, we normally get quarterly reports. We do not get a quarterly report in July because we wait until the final closure of the fourth quarter, which happens more in September and October. But because we did have such tremendous variance and really dramatic change of the health reserve fund, we did ask for an update on that one area in advance. And so I want to thank Amy for getting to this. It was not in the minutes, but you still managed to get it to us. So I want to thank you for getting to us. And we're at reserves at about 31%. We initially thought we were going to be at 35 and authorized 700,000. Then in April, we thought, oops, it dropped to 25%, and now we are at 31%. That still leaves us in a position, if trends continue, where there probably won't be a lot of reserves to use in next year's budget. So that will be something to start planning for earlier. And then a little bit later in the meeting, we'll look at a policy update on the use of reserves that Amy has drafted and get feedback on that. That's one of two policy updates that we'll be doing. Couple other things. I saw that Pullman and Connolly puts out their normal education notes, and that there was a new law passed that involves the Board of Finance. We were hoping to get some information on that. Public Act -26 requires that during preparation of the Board of Education budget for the ensuing year, the superintendent must provide local boards of education members with the original and actual amounts of each line item for the 2 preceding fiscal years and the original and current amounts in each line item for the current fiscal year. The same line item information must also be included in the itemized estimate submitted to the Board of Finance. So I just ask if we could get what that might look like, and we wanna obviously comply with the law, but also the charter.
What did you say it is, Public Act?
PA 26-1, and I'll send you the link from Pullman and Conley that has that, so. It's very rare that something pops up as a Board of Finance law, but it did, so I thought it was, we should get early insight on what that might look like. Cause obviously, in an ideal world, the reporting for the Board of Ed and the town will be the same, so that we can compare consistent budgets. And finally, Mark, just quickly, could you give us an update? Obviously, we're watching the vacancy rates. Where are you with that?
Well, early in the fiscal year, we're not at all unhappy. Chair, I met with the police chief. Obviously, it's police vacancies that we're most concerned with, and really the issue is recruiting. We're going backwards at this point. So, no issues there in terms of the budget, but the impact of having those vacant officer positions is potentially a driver of overtime throughout the year, so we're gonna be monitoring it. I just got word from HR that we're close to filling an IT position that's been vacant for a while, but other than that, nothing jumps out at us.
How many non-police vacancies do you have now?
5.
So you're on track?
Yep.
Okay, great. All right,
And 5 in police.
yeah. All right, so we'll now move on to, I have that right, the finance director's report.
So the first page, the approved supplemental appropriations, so this is where we're gonna land for June 30th, 2026. I added the last one that you all approved at your last meeting, the Simsbury Clubhouse hot water heater for $10,000. So our total supplemental appropriations for the year are just shy of 500,000 or 0.39%. So our target is the 3%, and then we would have to go back to referendum. As you can see, we're not even close to that number, so well within range for fiscal year 26. Moving on to page 3, just under the pooled investments. You can see that all of our CDs have been cashed out for cash flow purposes going into the final quarter. We have all of our teacher balloon payouts. We have a lot of our debt payments during this time. Still getting a rate of 3.7%. And then our next round will be after our tax collections in July. We'll reinvest in the CDs for another 3, 6, and 9 months.
The rates are still at 3.7?
Currently, right now, for STIF and the money markets, we're getting 3.7, so our CDs should be higher than that. Moving on to the general fund, so just a reminder that this is just a point in time, these are not final results. We still have things that need to be booked. Our final check run for fiscal year 26 is scheduled for the end of this week. We have accruals that need to be done. We still have information that comes in from vendors, things of that nature. But you can get a pretty good sense of where we are, starting with the revenues on page 5. So you'll see that we are already in excess of our budget of about $2 million. And compared to the same time last year, we're over that 100% of what we anticipated.
I have a quick question, just procedurally. I love the notes on the side that talk about, the variance. Now, do we not need to note where the variance is a negative number and what the reason for that is?
I typically, on the revenues, there is one that I did add afterwards, so the Board of Education one, that 229, that was a decrease in our tuition revenue. Related to the other ones, the community gardens, I think there was the assessor's office ones.
Yeah, there are just a few that,
But the police department, we just didn't have as many permit fees as collected as what he budgeted. the highway department, sometimes they'll do some scrap metal, we didn't have any of that. So it's basically whatever they budgeted for, we just didn't get the amount of charges for services that were anticipated.
Okay.
One thing that might be helpful, Amy, is when there are material variances, like Board of Education, that's almost $250,000.
Yeah, that's the one I told you I forgot
Yeah.
That's okay.
that I added.
Yeah. Just those material changes, you know, if it's $1,000 like assessor's office and all, that's okay, but the big ones.
Amy, can you talk about the tuition revenue? What was driving that?
So this is our out of
District.
our out of district, I think it's Heartland, I think we tuition in from a couple other surrounding towns, I think it's mainly Heartland. But we had an influx of Heartland students, I believe last year and the year before, that we did not have that same influx this year, so we budgeted based on prior years and we just didn't have that many tuitioned in students.
Do we think that's a trend that's gonna continue and be ahead to next year's budget? Too soon to tell.
I think we reduced next year's budget anyways, but I don't know, cause we didn't expect the influx from Heartland to begin with.
So one of them graduated, so that's it. Yeah, one of them graduated, a very good lacrosse player.
And Amy, I just had a question on the header. On the last column, 6/30/2025, received not final. Is that because it's the number before the final audit?
Yeah,
it's
so I
at
was
the point in
comparing, so I was comparing like apples to apples compared to what you saw last year.
At this point in time, okay, that's, I just wanted to make sure. And then we get the final to final when we do the audit, obviously, okay. Any other questions on revenues? Oh, I did have one question on the tax department, we're showing 700,000, I think excess. Is that where that was? Where is the
Oh, I
tax?
did have one question.
The 800,000 there. Can you break that out in terms of how much is due to the tax collection assumption? I think we had Mark, you got the delinquent payment in, would that be captured in that number?
Right.
It would, yes.
So do we know how much with the tax collection assumption rate came in at?
I can look, but that's just the department in total, but I can break it out.
Okay.
I assume the majority of it is.
But this is under finance tax department?
Yes,
Okay.
But your point, Chair, is it could be less because of that big payment. I got you.
exactly. And also we get other payments in there, it's not just the tax. I mean, one of the things we're gonna be talking about capital is how much is reliable tax collection assumption, so that's one of the things I wanna know.
One good news is we don't have a big number for prior year levy collections, like, you know, for example, Hartford, millions of dollars in collections from the prior years because of the rolling delinquencies, so
Right.
you know, that's one less problem.
And what is this Belden Trust? It's a small variance, but what does that mean? The intergovernmental transfer in Belden Trust?
So this is money that's approved from our Belden Trust Fund into our general fund to pay for, I believe they pay for part of Meals on Wheels and they pay for another portion of our public agency support. So the 28,930 is what was approved as part of the budget process. But when we go back to the Belden documents where they outlined what was actually approved, they did approve 36,090. I think part of that was for didn't we ask for the person last year? It was a part-time person that we were gonna utilize for
I
shopping.
think it was a supplemental appropriation funded through that last year, right? Was it, or no?
I don't think so.
I don't believe so.
Cause our expenditures were fine because we budget those based on what we know from the vendors, but the amount of funding that we're getting from Belden is contingent upon the
Just came in
trustees.
higher.
Was it the extra money?
And
we
is
got
that
from that?
No, that's this year.
That's this year.
Is that a continuing line item?
We have a number of trusts, like 6, 7, right?
Yeah, we have a handful outside of the pension trusts.
So those are actually, they have to go through probate and then they get authorized through the probate system. Then if we wanna spend them, we do appropriate them and those are done in the special revenue funds that we have in the budget section. That's where those get appropriated. But the probate court approves the amount of revenue they're sending to the town. The Board of Selectmen and the voters approve how we spend it,
So
just
are
like
these-
any other appropriation.
So are these trusts that people created and donated to the town?
Yes, for
Very-
a specific purpose.
That's awesome.
Yeah, so they date back years and years and years and years and years ago.
Some of them are odd, like one of them is for the poor in Simsbury unless you're poor and living in Terriffill.
Oh,
Because at the time, Terriffill was a
Was
very
different.
wealthy part
Yeah.
of the community
Oh, was
and they
it?
didn't want the funds to go there. So it is a very strange trust. I forgot which one that one is, but
Yeah, so we actually got rid of that provision, so we
you did,
we contested it with the probate court, and they did change it, so we were able to help out the individuals in Terriffill
fantastic
as
that you
well.
could get a trust document changed like that.
I mean, the will I think was back from like 1913 or something like that, so I think given the times, they changed it.
But when you look at the quarterly reports from Amy, the next it'll be the year end, she gives a summary of what each trust is and what its purpose for use is. And then the quarterly report shows how much is in there.
That'll be interesting reading to see what those things are.
It's interesting. They're also in our audit. You can read them there. The
Okay.
explanation of them.
I must have, and I probably forgot what they were.
Well, they're small dollar numbers, but meaningful to those who receive the benefit of them.
And theoretically in perpetuity, with
Right.
with some good management, so.
Okay, yeah.
Amy, you wanna move on to expenditures?
So on the expenditures, you will see that we are at 99.22 spent. Very similar to the same time last year, 99.51. Our variance is that we are below budget by 993,000. This variance will go down. So like I said, we have our final check run for fiscal year 26 this week. We also have some entries to do for accruals. We have some of our gap entries for the audit, so that will go down. But for this point in time, we're about $900,000 under budget.
Maybe when last we did our quarterly report, we were projecting 1.4 million and now projecting under $1 million. Part of that is obviously the debt service that came down 400. What are we projecting for the Board of Selectmen? They budgeted 29,64001. What are they projected at coming in?
I mean, I don't have that
I
offhand.
don't think I have that.
Where's the Board of Ed?
Find those files. Can read them tonight.
If you do Control F online, you'll find it.
That would be too easy.
So right now, they're at 887, 785.
I'm sorry, could you say that again?
887, 785. You just take out the Board of Education. I mean,
Did you take out the debt service too?
no,
So it'd be a little bit lower than that, right?
if I don't include debt service, then it's about 492,000. It'll probably be a little less than that if I were to guess offhand, but I don't do projections after we've already hit June, so that's a total.
So that's
Yes.
1% over. So that, to me, Mark, is sort of a yellow flag because you're counting on a lot of vacancy improvements there. So that means it's gonna require careful management on your
Keep
part
that
to make sure, cause that's tight.
Gotcha.
Okay, and then on the Board of Ed, I know we get the combined BOED and non-public schools. Do we break, is all that savings just on the Board of Ed side or is it also on the non-public school side?
No, that's just the Board of Ed side.
So what is the implication with the non-public school?
So I knew you guys were gonna ask that, because we have new members. So every year when we do the approval of the budget, I'll give that to Regina. Mike, I don't have it for you, but you've seen this 800 times. You'll see it has Board of Selectmen, Debt Service and Capital, Board of Education, non-public schools. That's money we have to pay for nurses, buses, stuff like that, and then the total appropriations. And so I was just trying to get an understanding of, like, if I were comparing the budget we passed to the update we're getting, how does it break down?
Okay.
That's all.
Okay.
And I forgot, this is probably a revenue question, Amy, I forgot to ask. Do we use all the 1.3 million in capital reserves as an offset?
Do we use all of the 1.3 million? Yes. If it was part of the transfers, it was included. So my projections, the thing that might have the biggest impact in looking at the difference is the employee benefits, because I have not allocated out the employee benefits to the other funds yet, so that's one of our gap entries. So everybody's paid through the general fund. Their salaries are attributable to say the Simsbury Farms Fund or to the Sewer Use Fund, but there is their benefits allocation, everything goes to the general fund. So when I transfer out those benefits, there'll be a bigger surplus in there. So looking at surplus projections to here, like that's why you can't
Okay, now I'm not gonna have a heart
trust it.
attack, okay?
No, can't trust
The
it.
way she was leading us into it, I thought, oh my god.
I was like, that
Yeah.
makes me feel much better, thank you, Amy, that
Yeah, so that'll be
clarifies
moved out, a portion of our insurance will be moved out.
You should state the conclusion first.
No, this was funnier.
Sorry. I wasn't expecting it, I had to look, okay.
that. Excellent, Mark, I'm relieved for you.
No worries.
Well, Mark didn't look worried, so I was watching him and I'm going, is this going to be the answer we want?
No, he's just waiting to look at me to see if I'm worried.
When she's worried, I'm worried.
All right, you wanna continue on through expenditures?
So there was one item on here, I don't think there was anything new really compared to prior reports for the reason and the variances, but I did want to, on page 7 at the bottom, under Parks and Rec, there's Memorial Pool.
Oh, yeah, I had that question.
So the statement is accurate, but either I forgot to put it or it just wasn't included, I don't know why. So this is going to go down this 126.85%. So this is another one of the gap entries that I have to do for deferred revenue. So that statement will be true after I do that entry, but basically we collect pool pass money in fiscal year 26 that's actually related to fiscal year 27. So I have to do an entry to take that money out of fiscal year 26 and put it into fiscal year 27, and then that statement will be true.
Okay.
It just hasn't been done yet as part of our year-end closeout.
It says sewer use paid? Is that what that's?
Yeah, so we haven't done the entry on that yet either, but we did it at the beginning of last year. I don't know where their sewer use bill is, but
So we
I know the person down
think
the
that
road.
will not show a deficit by the time you've done all
No,
that?
no.
Okay.
Yeah, some of these have small deficits, but they're all going to be corrected, or it doesn't, or the department in total is not in deficit. The only one is gonna be that liability insurance, which I had pointed out in previous reports, because we had an unanticipated heart and hypertension settlement that we were supposedly weren't gonna have anymore, and then another one popped up.
How much did we pay on that?
I don't know offhand, I can look.
What happened? What's the settlement?
I'd have to check and get back to you. I'm only aware of the one which I didn't know we had settled, so I'll get back to you on that.
Yeah, these are old claims. I can get the history from
Oh, no,
police
you know what?
department.
I believe
Our
it was,
insurance.
it was de minimis. I'm gonna say under 50,000, might have even been 20.
Yes.
We did get Board of Selectmen approval for it. We were represented by Attorney Harrington on that one. That must have been at the beginning of this fiscal year. I can get you the exact amount, Lolita, but we did settle it and it's the last of those. There were a couple of them going back a long time,
Years.
so yeah, we're done.
And what were they for?
It's for, I'm not an expert on this, but I'll do the best I can. For police officers who pass away, that where their estate can assert that there was a heart and hypertension medical issue that contributed to their passing, even though they didn't pass in the line of duty, they passed later. There's some specific state legislation that gives them a right to claim that their passing was caused by a work-related heart and hypertension claim.
There's a presumption that
Yes, Bert, help me out here.
or
that was good.
hypertension
Was that
are
good?
caused by the stress of public safety employment.
Right, and so unlike some claims, it
Is from coal miners.
Yes.
Mhm.
it can come to the forefront years later, and I think I'm not an attorney, but doesn't have the same statute of limitations and poses risks to municipalities many years after the person is separated from service potentially. So we have, as best of my knowledge, we have now resolved the last of those that we knew of, so this was good, and it wasn't a lot of money.
And just for the public, that is one of those expenditures, I believe, that you do not need an appropriation for.
It's
It's one of the
correct.
exceptions
That's
in the state statutes, but even though you don't need an appropriation in the future, when you make one of those, can you just please advise the board?
I will, yeah, we did take it to the Board of Selectmen and originally it was an executive session and I neglected to let finance know to let you know, so I'll,
No, they were on the previous reports.
they were, okay, good, yeah. Hopefully we won't have any more.
Excellent.
So interesting.
Amy, is there anything else you wanted to highlight in expenditures?
No, I don't think so.
I had one question. There's a series on town buildings where we have the budget increased, expenditures decreased compared to prior year. That doesn't really explain why. What's going on there? Do we know?
Yeah, so this is why I don't love doing percentage year to year, because your expenditures decreased, but your budget increased. So therefore, the percentages are skewed. Or even if you're like, just take it like you're spending the same, but your budget changes, so then your percentage is off.
But they're still pretty substantially under budget. That's an opportunity for next year.
Yeah, I mean, we can ask Tom Roy for specifics on them.
Looking at Public Works, town office buildings, library, and other buildings. Do you see that?
Yeah, I see.
The library was related to the electricity, that I know. That was corrected during the fiscal year 27 budget season, but I'd have to find out what the other town office and the Enid Memorial accounts were.
I thought the library was under the library budget for 2026. Is that wrong?
Yeah, so you had asked me about that before. I've always included the library as part of the public works budget since I started, just to keep all of the facilities together, and then library is just their programs.
But in the budget book, it shows it under the library department or?
Under the budget book for fiscal year 27, I believe we moved it out.
Yeah, right.
Right, so in fiscal year 26, it probably would have been under the library.
Okay. Any other questions? The savings in the assessor's library, that's all just due to vacancies.
Yes. We filled that, right?
The assessor's office. Part of that is part-time that we didn't utilize this year, I don't think, and then part of it is That's going to go down because part of it is going to be our personal property audits. And there is some that started in fiscal year 26 that we will have to accrue for.
Mark, just sort of a question, I know the library was concerned about being cut in the next year's budget coming up, or the year we're in. What was the thinking in not using some of those savings to purchase, doing an internal transfer there? Is it your?
So I think the cuts you're referring to are two specific cuts that were in different lines that had to do with reference materials.
Yeah.
We management wants to give the library time to make a better case for and the reason for that was we were doing our first foray into zero-based budgeting, and we used the library as an example of that. So we zeroed everything out and built up from the beginning, from zero. And the one area where we just didn't have data was reference materials. And what the library wanted us to do is, well, this is what we've always spent and we'll keep it flat, but that's not zero-based budgeting. So we did kind of shoot from the hip on that, and what I've told them is that in next budget, if they can make the case, we'll restore, some of that funding. That's why I didn't want to use year-end savings to muddy the waters, because we want to see what's the real community impact, and hopefully they'll be right, we'll find some money and put it back in.
Great. Thank you. Are there any other questions for Amy?
No.
Okay, we have the vacancy subcommittee update from Lalita.
Sure. Well, so Mark and I attended another
And Mark.
It's heating up.
Yeah, it's coming along nicely. And Mark and I wanted to go a lot faster too. And so does the whole vacancy committee. So I guess, so to bring everybody up to speed, we did the site visits. We took a look at some of the buildings. So one was very nice, the one on Mill Pond.
Yeah.
Really, really nice. It's completely vacant, ready to go. And then one is 82 Hop Meadow, which was by the Chubb building. Lovely location, but the building was vandalized. And it was really an eye-opener for us walking in to see what had been done to it. So I guess someone figured out a way to break a window and get into the building, and so we do have good buildings that are move-in ready, and now the question is, what should our milestones be to start reaching out? Mark proposed some tools that we could use because we as Board of Finance are sensitive to abatements. So he said there were other levels that we could be using. So we'll be relying on Mark for that. I was asked to put together a proposal to bring high-tech companies into Simsbury, and
You get the fun part.
I get the fun part. Lisa gave me a marketing study that had been done about 10 years ago, which is still really relevant. We can still use it. I don't think it's out of date. So we have that. We do have some marketing materials we've seen that the town of Windsor has put together. We can put something like that together. And then we did talk about bringing high bandwidth internet into town, because if you're going to have high-tech companies, you're going to need much better internet and wireless. And also wireless in the Performing Arts Center area, because they don't have that. So when we have these big events and they're using Stripe, they're not able to use it effectively. So there is some infrastructure investment that needs to happen in order for these companies to come in. I like the idea of high-tech companies because they're future-looking, and they take less out of us. They just need a space, and they need bandwidth. And so that's what we're looking at. The next meeting is on August 6th. I will not be there because I will be in India. But the work is ongoing, and hopefully starting in the fall, it'd be really nice to start making phone calls and seeing who's willing to come into Simsbury.
Great.
Yeah.
Thank you. Mark, is there anything you wanted to add?
No, just to give Sarah Nielsen and Main Street a plug for putting this together, and as Sarah, as I think you know, Chair, has been chairing this group that Lalitha and I are on, and it's well represented by our colleagues and stakeholders around town government, and I think, you know, again, for my part, I'm encouraging Sarah and the team to plan on issuing a written report in late fall is kind of our timeline, and so that we can get some deliverables and assign next steps, I think. So part of this is, as Lalitha said, are there any tools and incentives that we might be willing to put into our toolbox? What type of outreach can we do to others? But fundamentally, the issue is the drop in values of those properties, and what the town can do to help the owner get them developed, and whether it's attracting new businesses or a tear down in a mixed use development or something like that. I know at the Hot Meadow Street, I was told there's some environmental issues over there that might not have been, in addition to the vandalism of the building, underground issues in that area too. So, you know, again, fundamentally, we're looking at, you know, what could we do to mitigate the drop in values that we expect when the reval comes. So making progress, and hopefully we'll have some report out from the group in a few months.
Yeah, it's a good group and the pace is picking up. And of course, we want it to be faster, but it's going as fast as we can hope at this point.
Great, thank you both.
So as usual, I have to apologize for ignorance in advance of asking these questions, but you talked about some infrastructure improvements, that especially for attracting tech businesses, and what exactly would those involve?
It's primarily high capacity bandwidth for internet and wireless.
And is that something that town can work on, or wouldn't that be something that?
So one of the developers was mentioning that there is bandwidth available, and something needs to be done. It was too technical for me, but that it was possible to bring that bandwidth into town. And
Like where the fibers run to, we just need to pick it up.
well, there, the engineer can answer the question for me.
I'm sorry, could you repeat that?
Having not been in the meeting, but the higher bandwidth probably comes from a fiber optic line instead of a copper line, and so in order for that to work, it has to be continuous, right? Because if you have copper in the middle, it'll slow back down again, so.
That's what he said.
Bert, I'm with you. I'm learning as we go.
I know. I do
So
remember
it-
him saying copper.
So probably one of our neighboring towns, I'm just gonna guess Avon, but where am I?
Yeah,
Okay.
yeah.
Avon probably has some fiber optic infrastructure that could be continued into Simsbury, but at that, it's same as if you were gonna put in electricity for the first time, right? You gotta have access to the conduit and run it.
Or like a sewer, you're putting in a new sewer line.
It depends. So this sort of stuff is run in a conduit, which is like a flexible pipe underground, and a lot of conduit still has room. So depending on how big the conduit is and what the state of it is, it might not need to be like a dig up. At least to get like to the main street, like to Hot Meadow or something. Now by the time you go to the other streets, it's probably a smaller conduit.
Yeah, so that's pretty much what he said, not in such great terms of it. But what I understood was that the last mile was the issue because of, and then I heard him say copper, so there you go, that matches.
Copper slower, light moves faster than electricity.
Okay.
And I think we also learned, Lily, correct me if I'm wrong, that the problems with cell service are also, behind the curtain, that parts of town are, deficient, and particularly with one particular company that I won't mention, but certainly the dialogue has been good. I don't know what the solution is to some of those problems, but it's a good group of stakeholders working on it.
It's a good group, and I'd love to see better bandwidth because in my line of work, it's very useful.
Also, wouldn't it be a good thing to be able to announce that the town is investing in something that we expect will be of use to potential businesses?
Yes.
Couldn't agree more. That's the key.
Our board has been supportive of infrastructure investment over abatement, so that's aligned with where our board has been in the past.
Most service providers do have like plans for broadening, so it might be worth, the approach I would take is reach out to the local the frontier and everything, and where is Simsbury on their roadmap?
Mhm.
And what are the blockers? And if they say the blocker is something like a regulatory permit or something, that's probably a useful way to go have the conversation. There might need to be a repeater or something that needs to get installed, and if we could help with that piece of infrastructure, the rest of it should, I would expect, be on the burden of the company doing the service because it's their business model.
Mhm. I like that. We should take that back to the
We're already working on it. Our IT director reached out to those two companies just last week, so we're on that. I don't know what leverage we have necessarily to, and I'm not an expert on this, but we're starting to have those conversations.
The last time we talked about vacancy, you also identified, healthcare businesses as a potential source of new businesses. Is there some kind of improvement or initiative we could take that, something along those lines that might make us more attractive to healthcare companies?
Those companies need the bandwidth too.
They need the bandwidth. I know that in the locations that I was theorizing would be useful for outreach to the big healthcare. The good news is we've got the sewer infrastructure, which is that it's expensive to add that. The capacity at our treatment plant is good. There's some good points on the horizon there, but I think, Bert, to answer your question, the key has got to be at some point outreach by the town to specific players in the field, and to set up some very high level conversations at the CEO level with particular healthcare groups, and the sooner that happens, the better. I think those are conversations that have not been had yet.
To be continued, thank you for these updates, we're excited to see where this takes us. We'll move on to budget planning discussion. Amy, can you pull up the link I sent for the Massachusetts debt service calculator? I just wanna start there, cause that sort of
It's in her.
it was in the email I sent earlier.
No, I have the email, it's connecting it to the
Oh.
Zoom
Oh.
so that Mike can see it.
I have the link.
You do?
Mike, we can, you got a link, okay.
I don't need to see it. Don't worry about me. But I saw the camera come up and saw my giant head on that screen, and it's like, oh my god. I wish I was a little postage stamp on that screen.
Yeah, it's very intimidating. You're like Oz.
I'm gonna have to disconnect you, Mike, for a second.
Well, will that mean he's got to sign back in or no?
No, he's fine, like it just won't show him on the screen for a minute.
We'll say goodbye for a moment, Mike.
Let me just find.
There it is, the second link. This is from Massachusetts, and everything we're gonna talk about capital planning is sort of tied to this. It's how you borrow debt and what does it mean for debt service and how do you fund debt. And I just wanted to start using the Board of Education's proposal, thinking they were gonna need 68 million in bonding. If you put that in the top, the amount borrowed. Where bonds now, they're at about 3.5, do we think?
I'm not
I'll
sure.
put them in at 3.5 as a starting point.
Is
I saw some before.
squadron share?
Or in
But isn't it a reimbursement grant from the state? I mean, aren't we bonding
130 million project, 68 million bonded is what
So
they.
we bond 68, so you're putting 68 here instead of the 130?
Yes,
Okay.
cause we're not gonna bond 130.
I feel better because I had
Yes.
played with it and put in 130.
Oh, no, don't do that.
Gotcha.
Don't do that.
I think we're all aligned on that.
Okay, the way we do debt, Amy, we do mostly level debt service or do we do mostly level principal?
We do level principal.
Okay, put in level, well, start with level debt service, cause many towns do that. So you do an X. And look at what happens onto, if you can scoot down.
There's an
Okay.
amount table.
So what you get there is you get principal and interest. So we're borrowing 68, but we're paying 95 million because we have to pay interest. And you see the interest cost on that 68 million is almost a third, right? 27 million. But you see the level debt service payments at 4.78 every year. So almost 5 million every year. If you do level principal, oh wait, before you do that, change that. Lalitha, can you write down that number? 95 million, 691. And then the debt service.
Give me one moment.
I can write it.
Okay.
Wait, I also want to write.
The pen is mightier than the ebook.
Sorry, that's my son.
Okay, now switch that to
I need
Level
to take this
principal.
call, sorry.
step out of the room,
Yeah,
please.
just a moment. Thank you, sorry.
Okay. Now let's see what we get. You'll see that
One more.
the initial years of debt service are at 5.7 million. Bert, what were we before?
Oh, I didn't write that. Oh, it was 4 something. It was
4.7.
4.7.
4.7.
4.7.
So almost a million more by just switching that at the first year, but then look at what happens in the later years. Keep going down. You'll see the debt service drops to 3.5 million. So periodically, you start higher than you were before, but you come down, right? The advantage of that is the people who approved the project bear the bigger cost at the beginning. Later years, when people are looking back and going, Mark, Lisa, Regina, Lalitha, what were you guys thinking? Their debt service is lower in the later years. And as debt service falls off, what happens? You can start replacing it with new. If debt service never falls off, you have to wait the full 20 years to replace. Now, if you could go back
And
to.
I'm sorry, if you check both X's, for both, you get a comparison side by side. It's much easier to view.
Oh my gosh, that's why we love the tech people. All right, can you do both?
At least it did that for me.
There you go.
Yeah,
yes, it does.
Yeah, there.
It doesn't show the total amount. Oh, yeah,
Yeah,
it
it
does.
does, it does.
Yep, it's all there.
Okay, so
So
two
the
things.
point here is that level debt service means you're going to pay the same amount each year with a different balance of principal and interest
Yes,
each year. Level principal means you're going to pay off a set amount of principal
Mhm.
every year. You're paying more interest up front, and that's why the cost diminishes over time. Is that right?
Oh, sorry, say that again? I thought you were talking to Lisa.
Do you think I could do that, Joyce?
No, that is correct.
Okay, he's got it.
You got it. I'm with you.
but look at the difference in total costs. If you do level debt, level payment, you're borrowing more. You're borrowing 3 million more, right? And the one underneath that is only 92 million. So you are actually saving money by doing it the way we do it with the level principal. Now go back up to the top. And let's say we put down a down payment. Let's say we use 3.5 million, so reduce it by 3.5 million for capital reserves down payment. And let's say we say, voters, you wanna approve this? Here's some skin in the game, we're gonna tax you for a down payment of 3.5 million. So switch that. So it's just minus 7 million.
Minus 7 million?
Yeah, because we're gonna do 3.5 from capital reserves and 3.5 we're gonna tax for.
Oh, alright.
So you go on the other page. Just make that 61. And think back to the numbers we just saw.
Sorry, Chair, you're gonna tax for 3.5?
I'm not saying we will, but let's just look at what happens to the numbers.
Okay.
Suddenly, instead of 95 million of total debt, we brought our debt down to 85 million,
Well, actually,
83
level
million.
principal, it's
At
like
level principal.
92 to 83.
Yeah. So $9 million. So suddenly you're borrowing less. What we end up doing, we'll talk about as we get into the future conversations, but one thing I think we should think about is if it's 3 million in taxes, we say we're gonna tax for it, you have to do a down payment. And you tax for it the first year that you approve it, 3.5 million, yep, it's a hit to the budget, but what is debt service? 5 million. So it's coming. If you tax for it, you've got the 3.5 million the first year. Second year, what happens? You don't need it for squadron. What is that 3.5 million? It's now baked into the budget. What do you use it for?
Capital.
Yes.
Thank
Now
you,
you've
Chair.
got it, now you've got cash for capital. What happens in the next year? You don't need it for squadron. Now you've got 3.5 million in cash for capital. And so that's one way to think about that. I'm not saying that's what we should do, but we should at least evaluate that. Because one of the options we have is to use capital reserves during the peak of debt service to smooth it, but then in that case, we're not reducing debt. We're just the same amount of debt, we're using capital reserves. This way, you're using partial capital reserves, partial cash. It gets replenished in future years, so you can take care of all those other projects Mark and the Board of Selectmen wanna do. So I'm not saying this is the way to do it, but I think that is one conversation we'll be having. But the reason why I wanted to introduce it before we even start the capital conversations that we're gonna have is because I think Mark and I are everybody stop the presses, Mark and I are on exactly the same page. There needs to be some increase in tax supported capital if we're gonna make squadron work, because we can't just do squadron and nothing else. And our bonding capacity is going to be high, so we don't wanna extend the bonding, I don't think, or we may not want to, or we should at least evaluate how we can increase capital funding. So this is something we should all play with. And take over time, and we'll be coming back to it, but it's a really useful tool. One thing you can do, Amy, is what happens if you changed it to 15 years instead of 20?
So just for the purpose of the public's understanding, the reason why we would do that is to give Mark the capacity to attend to other capital projects and not be constrained because the bonding is eating up into
That would be one way. The other way is, it's a policy decision, how much debt do we wanna carry?
Mhm.
This will be the biggest borrowing project in the town's history by magnitude. So that's a policy call, is how much debt do we wanna carry? A lot of towns will say no debt. So is there a way to get the debt down? So those are one of the things, but if you go to the 15 million, you'll see that the debt comes way down, right? But what happens to the debt service?
It's way up.
Debt service,
I guess again, for the benefit of the public, if you've ever played with the mortgage calculator, it's the same math that we're
exactly.
looking at here.
Yes.
So we're talking about your bank's not gonna let you just do a level principal payment, right? But the math is the same, so all the tricks about paying your mortgage earlier, 15 versus a 30-year, that's the math that we've got up here.
That's exactly, and then we're gonna get into terms of, well, let's just do that and go the other way and let's just pay extra. Are we allowed to pay extra in the first 7 years? Or are there restrictions?
I mean, I think it depends on how you structure
It
it.
depends on the deal.
So that's one of the things. Now let's change the interest rate. Let's say it's not 3.5, let's make it to 4 and do 20 years.
Can we try 2.9?
What? Nope, not these days, Mark. Suddenly we're borrowing. That doesn't make sense. Why is that less for 20 years? Oh, but without the down, oh, I see, with the down payment, okay. Then you see the interest rates change. So those are the things we're gonna be looking at and where we think interest payments are gonna go. Generally, when we bond, Amy, we cannot refinance in the first 7 years, is that right? So we're gonna be stuck with that for 7 years. All right, so thank you for that.
All right, Mike, you're coming back.
But as an approach to building in cash for capital, right? We could take that $3.5 million slug up front and tell the taxpayers. You're the guys who are voting on Squadron Line. You need to pay for it. But if we're building it into the budget so that we can fund future capital, that means it's built into that mill rate, and we're going to need to give relief to the taxpayers somewhere else. So if we're doing that $3.5 million a year in capital, we're talking about committing ourselves somewhere to reducing other services.
That's one way to do that, or you say you're gonna do an increase in that year. The other thing that the 3.5 million spike does is when debt service spikes, now Mark and the future Board of Selectmen can say, use it for cash for capital, wipe it out, we can keep the mill rate flat. That becomes the policy call you can also make in future years. It gives some flexibility to future. Is it the right way? No, Amy's also has some tremendous scenarios that will also work, but I just wanted to include this in the mix because they involve policy calls. How much debt do we want? Do we think those who approve the budget should have some skin in the game? Should you make a down payment? When you buy your house, should you put down 5% or should you put down 20%? What are the best practices? So those are just the things we can think about. And then you see how impactful the terms are and the interest rates. Last I looked up, Connecticut does not let us do 30-year bonds, so that's off the table. So that's one of the things there. Next, we'll just move on to quick sort of where we are status. I think I've had a chance to talk to everyone about that memo draft I wrote. It's not meant to be anything dramatic, it's basically where we are, but I thought it was a good idea to get everyone on the same page and just sort of say, is everyone on the same page? Is this what we think we're doing? Is this what we wanna do? And if there's confusion, let's knock it out now as opposed to doing it in March. So that's kind of where I thought it would be useful to start because that's sort of a level set. And then in it, you will see one of my proposals based on Mark's goal of increasing tax supported capital was how do we slowly build that over time, forget what we just did. And I used as a target 2.5% of the operating budget, and how did I get that target? Farmington, because they actually have it written down. So I don't know if it's the right target. Eventually we would need staff to do a more detailed analysis as to what the right number. Right now we have 1 million in tax supported capital. To get us to the 3 million target, we'd slowly need to increase that to 2 million. It was 1.4 million, that was cut in the last budget, so we went a little bit backwards if that was our goal. And then the question is, how intentional do we want to be of that? We can increase, to your point, Bert, cash for capital, tax funded capital financing, but if there's no grand list growth, it's gonna come at the expense of either education, public works, library, trails, or the mill rate. So everything in the memo, I think hopefully, I'm sure you guys read it, I don't know if you did or not, but it was meant to be just sort of a guide and not prescriptive. It is one goal, we have many competing goals. Cash for capital in the last budget yielded to the goal of lowering the mill rate. And so my only point in the memo is when one goal yields to the other, we should call it out and just make sure that the policy choices are visible to everyone who's reading the budget, whether it's the policy board, staff, the public, just sort of, that's sort of how I want to do it. So if people would just sort of start on page 2 of the document. Amy, I don't know if you have the ability to put it on screen if you want.
My first comment is on page 3, but I can kick us off. First page.
Well, let's start at the beginning and then get to yours, because I actually have on page 3 a big 10 mark that says, Regina, you had a comment. Because she previewed the comment with me before the meeting, so I know what she's gonna say. I can put it up 1 second. One of the things, the first recommendation there, I think there's no disagreement there. Should we have a separate capital budget? I think every town in Connecticut does have a capital and an operating budget. I assume that's where we want to stay most. If you look at ICMA and a lot of towns across the nation, almost every town has a separate capital budget.
I have a question, so per statute, we don't have line item oversight over the Board of Education's budget. Do we have line of item oversight over the Board of Education's capital budget?
We do. When it's in the capital budget, it has to be approved by the Board of Selectmen, and then it gets reported to us in the quarterly reports if they want to exceed, which is why we had to do Latimer. They wanted to spend more, they had to come in for a supplemental
So
appropriation.
having one master list that captures the capital between the two sides of the town is reasonable. if
With
it's
one
right.
exception. The traditional payback, which is the internal loan, stays within their operating budget, and we do not have line item control over that.
And it would be the same with the little baby capital.
What?
Baby capital, I don't know, it's the thing that my name is written about.
Yeah, no, we do
'Cause
have
that
line of,
lives-
in the Board of Ed side, yes, the Board of Ed side, we do not have control over that,
I know
right?
it's not called the baby capital. I scrolled away from page 3, so I don't know
Okay.
what it is. Capital outlay below the threshold.
So there, too far. Go to one,
Oh, that's
okay,
actually good, Regina, baby capital.
I think that works.
I like that. Can we go on?
Okay, is everyone in agreement, we're gonna have an operating budget and a capital budget?
Yes.
Okay. Second one of the things I think we have been working for the last 7 years, we call it general fund operating transfer, maintain the goal of funding recurring capital primarily through the general fund operating budget. Recurring capital just means if it happens every year, that's the plow truck, that's materials recycling, it's the PD cruisers. Make sure that those are funded with tax supported dollars, just like every other recurring operating expense. That has been our goal that we're working towards. Do we always make that goal? No. But when we don't, we can call it out. This is a recurring expense. Highlight it, we didn't have enough money to do it. We did it with capital reserves. In future years, when we have the money, that should be moved into the operating budget. Is everyone still in agreement with that approach?
Yes.
The second thing, one of the things I tried to do is distinguish recurring versus non-recurring capital. Recurring happens every year and is funded primarily through taxes. Non-recurring does not happen every year, right? There's a variable projects like, a new truck that you have to purchase every 10 years, we need to purchase. Or there's a building that needs minor repairs. It doesn't happen every year, but it's happening this year. We have multiple sources for funding non-recurring capital. That means everything other than recurring capital. There's the general fund traditional payback, which is a set dollar amount of $416. Same dollar amount, different projects every year. I'm proposing general fund capital transfer, which would be just a new straight out. Instead of, it's like general fund operating transfer or general fund TP. It's a dollar amount for capital, but this is for non-recurring capital. Capital reserves, fees, one-time grants, donations, others, and then bonding for over 250, okay? We'll get back to whether, we wanna go for that, but I think our board has been supportive as finances permit, and finances have not permitted recently, that eventually it makes sense to increase our tax supported capital if we can. Is everyone in agreement with that as finances permit?
Yes.
Okay. So the next one, you'll see where I got the goal. Establish a town goal to contribute a targeted amount of general fund revenues through the operating budget to the capital fund and capital budget. A starting point for this discussion is 2.5%, but a different target could be set. The 2.5% is intended as a policy starting point, and it should be refined in light of historical capital needs, peer benchmarks, and asset cycles. And that's really management's job. What is the target? I picked one out of the blue. It has a rational basis. It's what Farmington, who is exactly our size, uses. But for our town, I'll leave that to Amy and Mark to determine what that long-term goal is and get back to us on that.
And just to be clear, we would meet that target by running the funds through general fund operating transfers and general fund capital transfers.
Or there's an
That would be
alternative.
the total amount of those.
Total,
tax
yes, of
payments.
all tax supported capital. So recurring capital and non-recurring capital should be 2.5% of the operating budget. every year the operating budget is gonna increase because of inflation and therefore the 2.5% should try and keep pace so that we continue to do methodical investment in our assets. Okay, next one. And this is one I put in there because there are different goals that are competing. One Mark expressed at our last meeting is one of his priorities was to reduce interdepartmental competition for capital reserves for non-recurring projects. One way to do that is over time redirect the TAR grant to non-recurring public works capital only, rather than using it to offset recurring costs or borrowing. That change will help reduce interdepartmental competition for capital reserves. If you do that, then it's not reducing debt. If you do that, it's not reducing recurring operating budget.
Chair, was it that way at one time?
It was, yes.
Because I couldn't agree more. I mean, I think
Okay.
that we are in complete agreement on that.
I actually tried to write this with your priorities.
I can see that and I greatly appreciate it. I think that like the 2.5, it may take several cycles
Exactly.
to get there. And that's why we attempted to start this in last year for this year, because time is of the essence. It could take 3, 4, 5 years to get us where we need to
Exactly.
be. But I really appreciate the effort and the work that went into this. I think at the end, I'll just comment on a couple of nuances where I think we might be able to strengthen it. But I like the idea, and again, I don't know that 2.5 is a better number than 2.2 or 3.5, but we can do the work on that.
We'll work on that.
Yeah.
But we know it's more than $1 million that we need.
And I think the clarity from the Board of Finance around some consistency.
Exactly.
Other things notwithstanding, obviously, if it's a crisis, it's a crisis, but
But then you just call it out.
Yeah.
This is our goal. We weren't able to meet the goal because these factors happened. Grant list came in lower than expected. Mill rate relief took a higher priority. And you just call it out.
Right.
But now we still have the roadmap. We made progress, or this year we didn't because something else came up.
Okay.
All right, so then the next one, capital reserves. Limit the use of capital reserves in the operating budget. Generally, you shouldn't use capital reserves in the operating budget. But we have used them for occasional transition periods like the ambulance. We would like to get that out of using capital reserves, and that if it's going to continue, it needs to be an ongoing operating expense funded with taxes, or if there's an emergency. Otherwise, maintain structural balance by using capital reserves for non-recurring capital. Why non-recurring capital? Because for recurring capital, we're using, which is mostly
Taxes.
yes. Good job, Regina. Again, as a goal, we don't always meet that goal, but that's what we're trying to do. Any use of the capital reserves in the operating budget should be clearly identified so that we know. Because we eventually want to move that down. Okay, then mechanics, and this I went over verbally with Amy, so did I translate it properly? I'm gonna rely on Amy, but I thought it would be good to clarify with this. So it's kind of strange the way we do it, and there is an alternative way to do it, but there's a logic behind it. We call general fund operating transfer recurring capital. Remember that's snow plows, PD cruisers. Those specific projects, you actually see them as specific projects in each department's line item. They originate there. And the funding for them is then transferred to the capital fund. The capital fund is where they're housed, and that usually happens, I think, on July 1. But we also show them as revenue in the capital budget. And why do we do that? The reason why is because it goes back to Mark's other priority is how do we prioritize capital? It keeps all capital funded items within one area so that you can see the full prioritization. That is the main reason why we do that. So if you go to the capital budget in the past, when you see funding sources, you used to see general fund OT, general fund operating transfer. It's a revenue there. So it becomes an expenditure in the operating budget, transferred to the general fund, shows as a revenue in the capital budget. Many towns do that. You'll see that as it becomes a transfer. The second one, we do general fund traditional payback. That is not in the departmental budgets because the projects are non-recurring and they change every year. So you don't want to tie it to one department. Maybe Public Works needs it one year, library needs it the other. So where we see that in the budget is in the transfer section. And you will see a transfer of $416,250 that goes from the operating budget to the general fund. And then you see those dollars as revenues in the capital budget. You'll see projects funded with general fund traditional payback, general fund traditional payback, general fund traditional payback. Board of Ed is the exception, that just stays in their budget, and that's because of state law where they retain line item control. Then general fund capital transfer is the exact same thing as the traditional payback. It's being used taxes to pay for non-recurring capital with one exception. How does that differ than the traditional payback?
No payback.
Yay! So it's the exact same thing. It's just another way to fund capital, but without incurring more internal debt-like instruments. So it's just another way to be more intentional about that. Is it new? It's not really new because
Well, maybe it's more accurate to say it's not pre-funded.
it's not pre-funded, right?
That's one
It's
of
pay
my,
as you go.
one of my points.
Yeah, exactly. So that's just one, and that goes back to our goal, but we're gonna do that. And then just on the bottom section, some of this is from the first selectman, what she had mentioned, the trade-offs. To Mark's point, we're not gonna be able to do it all in one year, and sometimes other goals like mill rate relief come in. And so in budget narratives, the town and board of education just clearly identify deviations from the funding policies or goals and describe any plans to return to alignment with those policies and goals. So that would be prime example. We cut tax funded capital in the operating budget this year because you were trying to meet the mill rate targets. So you just highlight that. We weren't able to do that. In the future, we do hope when the grand list grows, we do hope to increase that and bring that back into the operating budget. That would just be a call out, a trade up, so that the public can see, oh, this was a policy decision made. We had two competing goals, this one won out this year. Here's the reason. The next one is, and this is the Regina one. Capital outlay below the threshold. We define capital in our capital planning and financing policy. And I do not have the numbers off the top of my head. Equipment under 10,000 for 5 years, improvements over 20,000, 10 years life, infrastructure over 100,000, 10 years life. If they don't meet those thresholds, they're not considered capital. So can we label them? Other communities do label baby capital. We could call it baby capital. I just put capital outlay below the threshold so that they can be identified within departmental budgets. They are not considered capital because they're not considered capital. How are they funded? Taxes. So those would be funded by taxes just like salaries, benefits, everything else. We do not consider them capital. That is a policy choice. We chose those thresholds. Some people lower them to 5,000. I think Glastonbury has 100,000. So that's a policy choice we can make, but we should highlight those because they look an awful lot like capital, right? But by our definition, they're not. So my recommendation was just highlight it, whether it is not.
So you're not proposing to change how we pay for these things, it's just a matter of
Calling
reporting
it out.
them on the budget in a way that associates them with everything else that looks like capital.
Yes, so that you can distinguish them. Here's something that looks like capital, but it doesn't meet our definition of capital.
Chair, would the baby capital be counted towards the 2.5% target, for example, or is
No.
that separate?
That, because it's not capital. So that would be in addition to that, right, exactly. But, you know,
But it's
that's my
sort of
proposal.
capital.
So that's why my name is next to this, because I was trying to get a better understanding for what problem we're trying to solve versus is there any additional like administrative paperwork that comes from that. And as Lisa was explaining a little bit of the history of this, she said that some of the things that we permit with capital, for example, use of capital reserves, something like this category would explicitly not be eligible for that. So I'm a little agnostic if it doesn't have any label and it's just part of the operating budget, is that even gonna occur to anyone? I don't actually know if there's a bunch of administrative burden that comes from just labeling this on it. I don't think it hurts. But if we are assuming that that label means it is or isn't, it's different from capital, I think this policy should be really explicit about that or not bother with the phrase.
Well, so those items would not be eligible for capital reserves because they are not capital. Capital reserves are for capital. So they would be, you would have to tax for them just like, and you'd have to prioritize them with every other service provision you do in the operating budget. Now, to Mark's point, do we always make that? And if we can't, then what do? You call it out. We would like, these should be funded with taxes. We weren't able to do it this year. Here's our plan to getting back to that over time. This is how Glastonbury does it. When you look at it, they call it capital outlay. Anything that's below their threshold. You know, Amy's better at names than I am, so if you wanted to call it something else, baby capital probably is a little informal, but we know that's what we're gonna be calling it.
But it's intuitive, think of the public.
And it has a little bit of a humorous flair to it, which we like.
That said, if we're trying to emphasize that it is not capital, I would suggest not putting the word capital in the name.
I agree.
Not non-capitalized tangible assets or something like that. Like if the goal of the naming is to treat it separately from capital while still making it findable in the budget, just the 10 minutes that
Yeah.
some group of people will spend picking a name is probably worth it, so it's not a yearly item of discussion. Oh, this is capital, but it's not actually capital. But
So I'll defer to Amy and Mark on that. I just used that because it was identified the threshold and we were below the threshold because it kind of capital-esque, but
And are there any other, maybe a next question, so are there any things that would on paper meet the threshold but would not actually be treated as capital? And I'll just throw it out as one example. I know there's occasionally debates about software sort of things, right? So something that would meet a monetary dollar amount threshold, but is there has been a discussion, it is not being treated as capital, that gives you that tag as well.
So that is, I think, a great addition. I did not put in the technology because I do not have the expertise there, but we do put technology. In fact, there is actually a raging debate over that nationally.
I'm going through that at my factory myself, which is why I'm very sensitive to. If there's other things that are, we have 2 criteria here for capital 3, I guess, because there's the asset categories. If we mean this to mean exceptions also to that, it again might be worth the 10 minutes to actually lay out those assumptions.
Yeah,
We'll just save ourselves talking about it every year.
No, I think that that's right. And I know, Amy, you know, for recurring systems, we put that in the operating budget. But if you're buying a hardware or drives or stuff that I need Mike to detail, those might be capital. So that was beyond my capability. I do not have the expertise there, but I agree. And it is actually, for all you watching at home, a raging debate in the finance world.
Do you capitalize virtual machines? I want to know. Heard it badly.
So Amy, if you would be willing to give that some thought, that would be helpful to us, and then how we call it out. All right, then the next one, consolidated summary table. And this is where it is really important to the Board of Selectmen when we say meet your budget and they're looking for things to cut. Some capital, if you cut capital funded by capital reserves, does that change the mill rate? No. But if you cut capital funded by general fund taxes, that does change the mill rate. And Mark, you took advantage of that in this last budget. You cut that to make your mill rate. So it's really important that the policies understand which capital is being funded by taxes. We saw in Farmington when they had a crazy reval, probably worse than anyone in the state. And they were looking at over, I think, 14% tax increase, and to get it down to 10, they had to cut tax funded capital. So they had to know where that was. So that's where that becomes critical information. And then the other thing, to Mark's point, we can't do it all in 1 year. Sometimes in the capital budget, we have recurring capital that is funded by capital reserves. We know our goal is to get all recurring capital funded by taxes. So if we are using recurring capital funding by capital reserves, just call it out. We weren't able to do it this year. This is one over time we would like to move back into the operating budget. So it's just a call out so the policy boards can keep it on their radar. Oh, this is going to be a priority in a good grand list growth to move that back to make it more sustainable. We had talked about expanding the capital improvement plan. We're gonna need to do that if we're gonna do a 20-year squadron for major capital projects, not every capital project, not the minor ones, but we know roofs, mechanicals, fields, anything that has a major replacement. What we don't wanna do is have squadron line peaking,
When those things are.
8 roofs due and mechanicals at the same year. So just sort of get an idea as to what the other needs of the town are. And then departmental capital, continue the practice of noting departmental capital items and projects. Now,
I'm sorry, you said roofs, sorry. In our packet, where it had a whole bunch of our policies to renew, there's an item on page 21, and it's talking about our definition of capital.
Yes,
And it says, it's talking about like, there's some resurfacing roads is road maintenance, it's not an improvement, it's an
Right.
improvement if you're adding a turning lane. The next line under that, replacing a roof, carpeting, windows, unless the replacement has other benefits, are considered maintenance and should not be capitalized.
Right.
But roof has been used as an example of a capital thing.
except for major. I think there's an exception there for major.
So it doesn't.
Where?
See that.
It does, there is no, in the policy,
It doesn't-
replacing a roof is explicitly listed as an example
Replacing a
of
roof,
a major
carpeting,
maintenance
windows.
item
It's
that's
the
not
next,
capital.
it's the next paragraph.
The improvement, if the improvement increases capacity or use or significantly increases the useful life, it should be capitalized if it is over the threshold. Now, that is our ideal. We do not make it. You're right, we do fund replacing roofs as
I mean,
capital.
is there a time we would be replacing a roof for another reason?
So Regina, I think what you're looking for, so like replacing a roof, we might wanna like look at changing that language, but like the basically like repairs to a roof. But then below it says if the improvement creates use or significantly increases the useful life, then it should be capitalized. So I guess it determines how much of the roof being repaired actually extends its life. Or how much of the replacement extends its life. Cause sometimes we do little portions and you're not going to capitalize that because it's not gonna extend the overall life of the roof.
Okay, so it's
But
trying to
if
make
we're
a distinction
replacing
between
If we're
major
replacing,
patches.
right, if we're replacing an entire roof, then you're right, it would be capitalized. Yep.
Cool. Thank you for
We
that
can change that.
Alright, so one more question, we'll ask Amy to work on language to clarify that, cause
I'm
that
sorry,
isn't.
I think if you just
It's
say
a nit, but
repair,
like
where you
repairing
say
a roof-
replace.
No, that's valid.
If you bring that up as an
Yeah,
example.
yeah.
No, that makes sense. Alright, so will you remember that at the end of the meeting, we'll remember that, okay?
I remembered it for a week, weirdly enough, so I
Okay.
guess I can.
We
got
wrote
it.
it down.
Okay. Okay. Now, if you could just go down to the prioritization at the very end. And this Mark had asked for, and so I just put together one way of thinking about how we fund capital with flexibility. And that's on page 14. And before I get too far, I wanna thank Bert and Lolita who read this and helped me edit it, so thank you both for that. Alright, so start with, here's an illustrative of how it sort of all comes together for Mark. Without individual projects are prioritized by the Board of Selectmen and Mark. So this is not about this is really about funding sources available for recurring versus non-recurring. The goal is priority 1, general fund operating transfer taxes. That happens year over year, we should fund it with a predictable, reliable source. Preferred funding source is taxes of a long-term goal as finances permit. For the public, this is not a ton of items. This is, or it could be a ton if we added road pavement management. But, so start there. Mark's right, mill rate doesn't permit it. How else can I do it? You have 2 backstops. You can use TAR, we'd rather use it for non-recurring, but if you have to, you could use it for recurring. And then after you've used all that, you look at, we don't even have enough TAR, we're gonna have to hit capital reserves for recurring. If you do that, all you do in the budget, you put a note, you call it out, recurring capital not being funded by capital, goal is to get it back funded in the operating budget as the grand list permits. It's just called out that we weren't able to meet this goal, we had to go to tier 2 and 3. Then for matrix for non-recurring capital. If you can go, just scroll down. And again, I ran these by Amy verbally, so Amy, if I misconstrued what we talked about, definitely call it out. Non-recurring capital, this was originally designed so that it would never be cut. Once we had this, the Board of Finance designed it many years ago. This was meant never to be cut. So you always had 416 to spend on non-recurring capital. That was your base capital, and you always put in your highest priority non-recurring capital there because it was never gonna get cut. Then after that, we would put general fund capital transfer for non-recurring. We're in the non-recurring thing. I put that as a second tier because we haven't established it. We don't do it regularly. We have it in the agenda. In the referendum notice, you'll see it, debt service and capital, it's almost always zero. Then 3, for non-recurring, the ideal is we wanna use public works for non-recurring capital, that's what Mark was just saying. But we haven't always done that. In the last budget, we used it to offset borrowing. So that's why it became a third tier. Then fees from special revenue, they're restricted use tied to specific revenue streams. So sewer fees can only be used for sewer projects, Simsbury Farms fees only for Simsbury Farms, and residential properties only for residential properties. These special revenue funds were designed to be mostly self-supporting. So the fees should be able to generate their needs for capital. Is that always the case? No, especially with Simsbury Farms. So but that's one goal. You can use fees to raise the revenues to fund some of those capital. And then capital reserves. They're supplemental after tax supported and dedicated source have been exhausted. They're a variable funding source. Amy thinks they're about 500,000. Annually, I'm a little bit more optimistic. I think they come in closer to 700, but it's somewhere in there. The rest are variable. The part that's sort of reliable is the tax collection assumption, but we've seen that, even that varies wildly. One year it was like 200,000, one year it was over $1 million. And then one-time grants and donations, opportunistic as available, and then of course bonding for projects over $250,000. Now, if you could just go to the chart, only because I'm super proud of this.
It's a great job.
On page 6. Okay, this sort of ties it all together. You see taxes. How do we fund capital through taxes? Through the general fund operating transfer, recurring capital, general fund traditional payback, that's the 416. Recommending the capital transfer, the new thing where we just tax for capital. Those are funneled into the capital budget and the general fund where they get prioritized and where we make the appropriations from. The general fund and the capital budget also receive revenues from capital reserves, grants, fees, donations, and others. Those are in green because they don't impact, they're not taxes. And aside from Mark and capital reserves, yes, capital reserves are funded in part from prior year's taxes, but because they're prior year's taxes, they don't impact the current year mill rate when you're thinking about how you want to fund it. And then you see debt service off to the side. Don't forget about debt service. We pass it in 1 year, it doesn't hit the operating budget, but we pay debt service with taxes in the future. So that's always looming there. And sort of that's how it all sort of came together. And you can kind of see how they're all interrelated. So I want to give Amy, since I sort of inundated you with that phone call the other day, did I get everything? All right. The other thing we could do, and it's in the alternative, and this is my Regina paragraph, because she always says, can we make it easier? But this will go against one of Mark's goals, so I just wanted to raise it. Let's see where the alternative was. Can anyone find that in the thing? On page 11. This is actually my preference, but it doesn't capture Mark's priority, so I don't have a strong preference there. So instead of having all these little transfers in each budget, snowplow and public works, PD cruisers in this, something else in another department, you could just do one tax for capital transfer in the transfer section that covers all of them, and then differentiate the funding sources in the capital budget. You could show this is traditional payback and everything else would just be cash. So that, I mean, it would just make it cleaner. So I just think but the problem with that, and why I didn't suggest it as the primary, is because Mark, you'd said at the last meeting you really wanted to tie some of the capital to the departmental budgets and keeping it in the line items. So, I mean, I think you can tie it in the capital budget just by highlighting this is a public works recurring item. That's always gonna be your top priority, right?
You know, I appreciate both sides of this argument, Chair. I think I really don't have a horse in this race. I can share with you one of the, and this goes back to even my first budget here a few years ago. And this is from staff, that historically department heads have a different level of advocacy skills when it comes to advocating for their items. So they get through the town manager. I put it in the budget and it's part of the town manager budget, but at the Board of Selectmen, department heads come and they make their case. And the department heads have different strengths and weaknesses with respect to advocating to our electeds. Well, I want this and I want that. And you know, I heard that from the department heads. I mulled on it, you know, over a couple of budget cycles. And, you know, I personally, this is just my opinion, believe that in this change to the town manager, CEO form of government, that those types of interdepartmental choices should at the very least be given deference by the Board of Selectmen with respect to the choices, because I'm able to look at these individual items and rank them based on my understanding of the day-to-day needs of the organization, as opposed to the skill set of advocacy at the budget workshops at the library, right? So you imagine department head X is frustrated that for 3 years in a row, this particular recurring item has not been, it never makes it in, even though it's only 30,000. And the idea that the electeds at the Board of Selectmen anyway might cut based on the amount. You know, they don't want to cut something that's 70,000 because they don't need to. They're going to cut something that's 30,000. What I've seen is looking at the budgets over the years, that there is a preponderance of similar items being cut every year. Not just by the Board of Selectmen, but even by me when I did it. I've cut several things, didn't make it into even my third budget. So, you know, that I don't really have a horse in this race, Chair. I understand both sides. I like, you know, and I'll just say I really like the work that you all have done on this, and I appreciate the effort to kind of, you know, because you've captured very, very well the key thing from my perspective going back to last year's budget cycle, and that is the need to migrate more cash, and we're all in total agreement there. And this way, this suggestion accomplishes that as well or better as mine from last year. I do have a couple questions whenever you're ready. If you'd like, I could do them now.
Yeah, sure.
So I've never been too clear on recurring versus non-recurring. I just want to see if we can think about that as we review this to do a better job of clarifying what it is. I'll give you an example. A police cruiser, where you might buy on your fleet management, say you're replacing a cruiser just hypothetically every year. Is it recurring? You're getting a police cruiser every year. In my view, it's not recurring because it's not the same cruiser. It's a cruiser every year. So in that example, is it recurring or not recurring? The same thing to IT. If we're always putting 30,000 into IT software, is it recurring? It's not the same software, but you see on our CNR expenses over the years that there's allocations made for software. So that's an example. So remembering from our research last year on CNR that CNR was initially and originally enabled by the state legislatures passing, I forget what section it was now, to provide municipalities with a way to fund non-recurring one-off purchases and to spread them out over a number of years because you've paid cash for it. If you bonded for it, the debt service is spread out over the useful life, but it's not if you pay cash for it. And this is particularly important to your point, Chair, that if you're shifting cash for capital, if your capital expenses more to taxes, which is our shared goal, you are also making this year's taxpayer pay for 100% of the $63,000 pickup truck, for example, right, for DPW, when the CGS enabling legislation it specifically carved out this option for us to spread it out over 5 years. So this is sort of the yin and yang, which I think I've struggled with, and I appreciate the dialogue on it. So my question is, if you're getting a truck for DPW that's $50,000 and it's a different truck every other year, is it recurring or non-recurring?
So the Connecticut General Statutes defines recurring, and to your point, it's a little bit of art, right? As an expenditure for a purpose for which an appropriation was made in each of the last 3 years. So if it's for a plow truck, the purchase is the plow truck, so it would be a recurring expense. But you're right, I mean, we do need some clarity there, which is why, some things you might say to me, Mark, come to the Board of Finance and say, I'm not going to tax for this. I don't think it's recurring. I want to use capital reserves. And that is a policy call that we'll have a discussion about, and that might be perfectly reasonable, but we call it out. We just say, here's a gray area. I put it here because of this.
Well, if we're gonna stick to the 416,250, which is fine under this scenario, I think that we wanna make sure that funded out of that 416,250 on the municipal side are items that are clearly non-recurring.
Absolutely, it's required by law, yes.
And that we haven't always done that,
Right.
which is
I agree
so
100%.
I think we're saying the same thing, but the
100%.
prioritization for the
Exactly.
traditional payback 416 is gonna be something that's clearly
100%. Now, the other thing that does
Wait,
permit.
I'm sorry, before
Sorry,
I move
Richard.
off of this, but I tried reading all of the policies, and so what you just said conflicts with our current policy on what the definition of non-recurring capital is. So, which may be adding to the confusion, so page 29, section XIV, the capital and non-recurring fund. So it's as part of that, but there's a sentence under section A that says, non-recurring means an expenditure that occurs no more frequently than once every 5 years.
Oh, you're right. So that has changed. We should change
So-
that to 3 years.
Well, it isn't so much the 3 or the 5, if I understand your point rightly. You're exactly right. It's
a little
is
bit
it
of a-
recurring or is it not recurring?
It's a different question.
And a police cruiser, they're same cruisers, but if you buy one in 1 year and one in the next, it doesn't make it it makes it recurring. It's
It's recurring because it's the same purpose.
That's
but
right.
it's a different vehicle.
Yeah, but but the definition of this legislature was purpose, so not the vehicle. So it's
But that sentence you just read from CGS says a purchase, not multiple purchases. It
for
says
a purpose,
for
for
a-
which, for a
but
purpose.
prior to that, what was the sentence before?
Defines recurring items as an expenditure
As
for,
an, it's the word and right there, that word
as an
and,
expenditure
right?
for
One
a
expenditure.
purpose.
One expenditure and a singular expenditure for one vehicle.
All capital items are a single expenditure, right?
Yeah,
And so what is the purpose of the expenditure? It's for a plow truck. I mean, we
So
can,
the
no, if
act
that's,
doesn't
look, if that's, I'm not arguing, that's fine, if we understand it, that a new police cruiser every year is non-recurring.
that would be
that'd
recurring.
be recurring.
Because of the purpose is there. It's just like, salaries are recurring,
So we would not fund that out of traditional payback.
correct?
Gotcha.
That would be
Okay.
just plain old tax supported.
Yeah, and these two sentences can be read together and it would be completely consistent. So you'd see the expenditure for a purpose and expenditure for a purpose does not mean one expenditure. But it's the reading of the sentence is that it's the expenditure for a purpose.
So I have one other example that'll help me clarify this. If you're spending, say, every year $20,000 to repair playgrounds throughout the town, but they're different playgrounds, they're whatever, it's a different playground. Is it recurring or non-recurring? I'm
So
spending
then
it
if
every
you
year, but
So how often would you have to do that playground?
we've been doing that. That's been the past practice, is my understanding, that we've
This is
built
5
it
years.
in to CNR, capital non-recurring, even though it's the same 20, what, I meant, this is, I may be
I think
wrong.
he's asking what the life of the playground is,
Oh.
like how often would we replace it?
I'll go
How
back
often
again
would-
to, if the improvement increases capacity, use, or significantly increases the useful life, then it should be capitalized if it is over its threshold. Because that paragraph talks about other forms of maintenance, so in
This
the
is,
absence of anything else, that looks like what we've got right now.
So what you could do, so if you think about it, it is, remember, G fund, general fund, operating transfer, general fund, traditional payback are all capital. So it's just, are we funding it with taxes or not?
but if it's maintenance,
It should be funded with taxes
not in the capital budget, it should be
in the
in Parks and
operating
Rec.
budget. So it doesn't get transferred, yes.
Right.
Is
I
it,
think
are
so.
there gray areas? Yes.
Well,
And
that-
Amy, if you could help us define some of those
Isn't
gray areas.
the point, right, cause we can get into the metaphysics of what's identical and what's not and what's an individual and what's recurring, but isn't the point that if our program of acquiring police cruisers or maintaining parks is a predictable cost of operating the town and providing the services we provide every year, that is something that should be paid for with taxes.
Absolutely.
Yes. Well, is everyone in we have everyone in agreement on that? I think we do.
Oh, I think we do, absolutely. I think that if I have this right, that historically, maintenance of playgrounds has been run through CNR.
Because there wasn't money, right?
Right, but what that did was because 416,250 was locked in, the maintenance of the playground effectively reduced the 416,250.
Yeah, that's not a good, because that was recurring, you're right, so it needs to
Recurring,
come out.
It's not capital, it's
Exactly.
not capitalized, and we end up without the the benefit of the 416,250.
Is for the, 100% agree,
Mhm.
okay,
Yeah.
cool.
And then the only other thing, Chair, is to this, and again, there's virtually, the only comment I could make is that our goal to get to 2.5 or whatever that number is as we look to increase the cash for capital. To Bert's point, the pressure on the tension on the other side is mill rate relief, right? If we could ask the Board of Finance to consider a strategic roll-in based on groundless growth. I know you and I have had this conversation and
Absolutely, but then you come to me, put it towards capital when there's groundless growth, don't
That's-
use it for police, don't use it for,
right,
we can
that's what I'm
absolutely do
thinking.
that.
But all we want is some clarity that in a year, let's say we all agreed that the base groundless growth is 1% or whatever number the board likes as the policymaker. In excess of that, in a year that we have excess groundless growth beyond that base number, those are the opportunities to increase the cash for
Absolutely.
capital and build it in because it doesn't impact, at least
Exactly.
overtly, it doesn't impact the mill rate.
So that depends on the Board of Selectmen goals, so if they came in and said, I want a zero tax increase, then you couldn't, but if they're comfortable with the 1%, you could use the capacity to, yeah, so and it's always gonna compete with other policy goals, but yes, I think we should absolutely do that. When it meets the other policy goals. There's always a trade-off, we can do that, but the trade-off is the mill rate could be less, the trade-off is you could spend more on education, the trade-off is, so that's,
I think what we're hoping for, we don't have an answer for this yet either, but at the state level, they're called guardrails. I imagine guardrails here that would give some protection to your cash for capital, because when you do have those pressures, I think we can all agree those are the items that are cut first.
And we saw that last year.
We've seen it cyclically at the town, and the best laid plans oft go astray.
And that's what G Fund OT and G Fund TP were meant to never ever be cut, and they were cut in the last year's budget. So that's gonna depend in part on management and the boards. I mean, I can't force you not to do that.
Well,
Right.
the traditional payback was cut in my last budget in an effort to begin the process of migrating it to operating. So that's an outlier. Nobody plans on cutting it again because you've overlaid in your proposal a new mechanism to and the transfers were never the issue. Itemizing everything in capital is more transparent. It's just that I think from our perspective, we don't want to create a situation where capital is always the low-hanging fruit to be cut.
It always is though.
Well, but that's what gets, even the state's in trouble. You need those guardrails that says, or say, particularly in years where you do have groundless growth, right? As you said, Chair, we've faced some years without groundless growth.
Well, that's why I think one thing that will really help us is setting the target to 2.5. So when you come in and you're reducing the path to this goal, this board may get stop, find somewhere else to cut.
Right.
That's where this will be helpful. But we really do need from you, what is the number? Is it 2.5? Is it 1.5? Is it 3%? I think Farmington may have up to 3%. And some towns are 100%.
Right.
So where do we want capital 100% by taxes? So we do need some analysis on that, and we depend on
We can do-
staff, yeah. You know, we need your guidance on that. But Amy, in terms of the alternative, you know, I call this the Regina, keep it simple. If we just did one transfer, in some ways that's a lot cleaner because we could show debt service, cash for capital transfer, and then in the other budget, you divide them up. Your priorities are gonna be marked recurring capital. You better fund those first, or Board of Finance is gonna come after you and say, what are you thinking? Then your top priorities are non-recurring would be the traditional payback. And then after that, you can start, you know, resources as available. And as we slowly build up, your life gets easier, but that puts pressure on there's no way to get around the tension that in years of low grand list growth, somebody else is gonna suffer a little bit, whether it's the residents or a department.
Yeah, and that's just the nature of life.
Yeah, I think we have complete agreement, and we've had a lot of conversations about how we balance things when there isn't grand list growth. I'm not sure we've had sufficient conversations around the issue of how to plan for when we have grand list growth over X, whatever that base is that we're saying it is. And that's a policy decision, but whatever it is. And then above that, we have some flexibility to build it in, because if you don't build it in then, it will impact the mill rate in the future, I think.
Yeah, no, I mean, I agree with that. The problem is it can't just be the one factor, because it's not just grand list growth. You might have grand list growth, but a slashing of state revenue, in which case it
Yeah,
impacts the
clearly.
mill rate. So it's many factors. So but in years when you're looking at a 0% tax increase and you, because of grand list growth, maybe you up that a little bit so that you fund
Fair enough,
cash for
yeah.
capital and do the investment over time, so you don't have the higher expense at a later time.
Yeah, and I totally agree with you on capital reserves too. We had that conversation, and you saw we used less last year than I think even the Board of Finance expected we would use and request. So, you know, I think if we can get to close to zero on the use of capital reserves, that would be great, so.
So we have two things that we request on this, an analysis of what the target should be, you know, based on past practices and benchmarks. How to think about technology and where that is. Any third one would be clarity on recurring, non-recurring. Amy, if you could help us think about ways we could categorize it. What we should do is, I mean, hopefully you guys come in, I funded all non-recurring in the
416,250.
and the new
Yeah.
the new section, and I funded all recurring capital with taxes, and then we show deviations where we couldn't make it. And then Amy will help us define recurring and non-recurring, what to do with taxes. And for capital below the threshold, if you wanna come up with a new name that is less cumbersome, maybe a little bit more formal than baby capital.
We'll put our minds to it, Chair.
Okay.
Trinkets, trinkets.
Alright, were those the main things we wanted to change based on what we put forward today? Does everyone feel comfortable? I mean, I think let me just say, this was not based on, oh, I have a good idea. This is based on probably multiple years with Mark conversation. So this is just sort of the culmination of trying to put it all together and capture everyone's concerns, but retain flexibility and be realistic that you can't always meet every goal that you set out to do. Is that fair?
I think it's very fair, Chair, and it solves that problem because you're gonna have declining surpluses contributing to capital reserves, which was what was causing us the concern last year. So I appreciate the work that you've done.
And then, Amy, if you could pull up the capital project sheet, we'll do that, and then we'll get to the modeling, and then we'll be done.
Definition.
Oh, I have it. It's in one of the footnotes. I think footnote
I didn't
It's messaging you all.
He had a suggestion for the name.
I didn't see that.
Durable, non-capitalizable expenses.
Maybe a little shorter?
We'll let Regina and Amy work on that.
Can you come up with an acronym that's as cool as Dracula?
Yes, that's true. Frankenstein.
Yeah.
If you pick the acronym first, it's called a backronym.
Just a couple things that came up, in our policy.
Backing into-
We'll just go through some of the ones in there and that our sheets do not have the capacity to add, but that are in our policy. We had talked about in our policy adding projected start and completion dates because that's standard. Priority classification or rank, whether, our board suggested low, medium, or high. But I think the Board of Selectmen adopted a numerical ranking, which we included in the policy. Whatever it is, just put the rank in there so we can sort of see where that falls in. If it's recurring or non-recurring, it should be listed. Identify any the projects either by replacement, expansion, renovation, right-of-way acquisition, so that people understand what it is, especially for small capital like vehicles. We ask that every time. It just seems that should be.
Are you reading this off from somewhere or are those your
Yeah,
notes?
my notes.
Can you just send them to me? No, I don't.
Yeah, sure. And then total cost, including prior appropriations. So those show the future costs, but there should be some way to show past expenditures. Cause sometimes they're the second or third tier of a project. I think these are the ones folks have given me in the past, but is there anything we've forgotten? Oh, square footage for new construction, cost per square footage. That's something that get asked every single time, so just do that. Obviously for equipment and vehicles, the little stuff, we don't need a lot of detail other than is it a replacement? And if it's a replacement, what are you doing with the old one? Is that good enough? All right, as things come up. All right, thank you. I'll get this, my job to send this to Amy. All right, and now if you could pull up the budget model. Amy, when I tried to play with, first of all, thank you, it's really a great model. Mine didn't work at home because I was getting this circular.
Yeah, I can show you how to fix it.
But before we even go through scenarios, can you give just an overview of what each tab is and the variables and the assumptions in each one that you worked out?
Yeah, do you want me to start with the first squadron as an example or?
I would just,
2,
the base one. Which one?
number 2.
Number 2, whichever Mark wins, we'll start with.
Thanks, Chair.
You want squadron 2?
Yeah.
Okay, but
I'm just more familiar with.
can you start with the levy calc and just sort of remind everyone how that works? And then what you did, does this one have the reval worked into it? Okay.
Yeah, I'll do, yeah.
Yeah, so go through all the assumptions you have in there.
Oops, sorry, Mike. Okay. So your levy calc tabs, this is what you're used to seeing during the budget process where we have our town operating, our school operating, any cash for capital that we've added, our debt service, it takes us to our gross expenditures, our anticipated revenues, if we're using any reserves, and then this brings us down to our net expenditures, which is the amount that we have to tax for. So taking the amount that we have to tax for, we take our grand list and we translate it into property taxes, we add our car taxes, and then this is how we come up with the total property taxes that then matches your net expenditures. And then we input our tax collection rate to get our mill rate, and then down here is we have our home impact. So this is our levy calc out for the next 15 years.
Amy, what are you assuming for budget growth?
So we have 3% in there.
One of the things when we go through this, we should consider raising that to 4%, especially given the fixed costs that we saw recently, and do different scenarios for stress testing it. What if our operating budgets, because we saw with Latimer, when debt service hits, we really gotta come in with the lowest budget ever, and we came in with the highest budget in the town's history. So I think we should assume,
And what happened there?
I don't know. It was there were some union negotiation, I mean, it was coming off COVID, there were just, the budgets were haywire at that point. But, and it was prior to Mark being here, but I think once we get to actual scenario planning, we'll look at 3, 5, and 4 as we change those scenarios, because those will change the bottom numbers. Is 3 realistic? Can they get to 3% budget increases? I don't know.
So also this modeling is pretty conservative in that it doesn't project for any revenues in the out years. And we know that our revenues are gonna increase, so there is some room there as well. So if we're gonna change that 3, we should probably bump up some of our anticipated revenues as well.
Yeah, so I mean, I think we wanna look at, Art had used an expression, I can't remember, comprehensive, but
So what would be the assumption for revenue increase?
So under this scenario, we don't, just for conservative purposes. The only thing that I have added is, you can see it in the out years, is when we hit the motor vehicle cap and then we get a reimbursement from the state for our motor vehicle taxes. But aside from that, we've always just been conservative because the 3 is so low compared to what we've had in prior years. We just haven't changed the revenue, but there are certain things that'll go up, like our shared services contract, things of that nature that'll go up. So that's kind of why we have the conservative revenue, because we have the conservative expenditure increase.
Do you see a scenario where the revenue projections are conservative but the expenses rise faster?
I mean, it could.
No.
well,
Yeah.
what do we know for non-tax, we have the history of past non-tax revenues. What do we know, could we sort of take a look at that? What have those been over time?
I mean, we could. It's really the state revenue that has the biggest impact. So barring any changes from state revenue, which go up sometimes and threaten to go down other times. And so, I don't know, I mean, I can take a look, I just don't know if I would trust it.
So but I think we should do some scenario testing. Expenditures go up 4%, state revenues stay flat, looking at the state budget. I don't think that's an unrealistic scenario.
Yeah, I mean,
But also at the same time, I mean, you can use whatever scenarios you want. Like this document is free to
Right.
all of you to just play with if you want to look at 4%. But when we created this document initially, remember the target was to stay around a 2% tax increase. Was the target for the board. So if you want to stay around a 2% at the time before the reval, you could only have a 3% budget increase.
Right.
So I mean, you can make it whatever you want to, but then your tax increase is going to go up.
And that's the
It has to
beauty
be-
of Amy's model. So you can play with this, and we should play with this, and most people do different stress test scenarios when they're doing long-term planning. Best case scenario, worst case scenario, likely scenario. Well, Amy, can you talk about what you did in the reval year?
Yes. So on the reval projections, we have our impact year, fiscal year 29. So I just chatted with Francine to see what she's seeing in other towns that have recently completed their revals. And she's seeing that there's probably gonna be about a 25% increase in our grant list. So I took the 25% and I added on, she originally had anticipated without reval, we were gonna have a 0.83% increase. So I took the 0.83 and I just added the 25% to it.
And then what you did with the home values, you changed that too. So someone with a $450 valued
Right.
home now has a home that's valued 25% more.
Right, so
Same home.
Right, so if you take, so there's a couple things here. First of all, if you have the 25% increase, you can see that your mill rate dramatically decreases. So you go from 34.46 to 28.64, which theoretically is good news, but that also impacts our motor vehicle income. So we no longer qualify for the state reimbursement. So that is a loss in revenue. And then as Lisa mentioned here, we typically have a $450,000 home, but if your value is going up 25%, your $450,000 home is now, $500,000. So we updated that to see what the tax increase would be. And although the mill rate is going down, your property value is increasing so much, it's actually an increase in taxes.
Which is what happened last year.
And
Mark-
just as a caveat, that is not for all
Right.
levels of housing. So your high level market, your medium market, your lower level market, they all might have different levels of impact. So this is just on that $450,000 range.
And that 25% increase is not going to be distributed equally among
Right.
homeowners and commercial property, so that this is potentially understating the hit that the $450,000
Yes.
homeowner.
Yeah,
That's going
depending on what commercial does.
We saw
correct.
some people over 12% in the last reval,
30.
some with 30, yeah, and some with 40.
Mm-hmm.
Those numbers were smaller. Our medium increase was 5.18, but we saw a significant 10% had over 12%. So that was a significant hit to them. About 10% saw a tax decrease. Okay.
So that's basically our grand list projection tab. And then our capital improvement tab, this is just where I have how much we're going to be bonding over the next few years. And then this just translates into our capital financing tab. So this tab is actually the same as what we did. I'm just gonna move the mic over here. The same as what we did at the beginning of the meeting when we went on the website for, I believe it was Massachusetts. So you can do the same thing here. So you're gonna have your assumed rate for fiscal year. This is the most recent issuance. But if you have fiscal year 27, you have the 3.5% rate. And then you can have the fiscal year budget impact. So if we issue in the spring of 2027, it's gonna impact our fiscal year 2028. And then the amount issued, the term, and then down here is your structure. So your little chart over here, number 1 is for level principal and number 2 is for level debt. This will give you your payment and then it'll give you your amortization schedule out for those years. So just to see how it works, if you go to fiscal year 28, I'm just going to highlight that, say in orange, that's our debt service. Say we'll put the squadron project in here, so we'll do 60 million. And we'll do 20 years, we'll keep it at the level principal. And then this will translate into the levy calc, what your new updated debt service is. So it's completely interactive based on where you want to see your projects in what year.
One of the things, and thank you for doing this, you have the tab on Henry James and Latimer. Traditionally, the town does not start a new project until an old major project falls off. So what are we paying for debt service in Henry James? That's gonna be the first one annually in debt service, and when does that fall off?
So for Henry James, so for fiscal year 27 for this year, our Henry James debt is gonna be about 1.4 million, just shy of 1.4 million. And then this one is, our first issuance is gonna fall off, the last payments will be in fiscal year 35, and then our second issuance, the last payment will be in fiscal year 36.
So 1.5 is not the 5 million we need, but it's a help, right?
Right.
And Latimer doesn't fall off for many, many years still.
Right, so Latimer I think is already down.
What are we paying on debt service a year in Latimer?
So So for fiscal year 27, our payment will be about just shy of 2.2 million.
So 2.2 and 1.4, so you can see that's 3.5. If we were doing one project at a time, we could more easily afford Squadron. This is why it's gonna be hard, because it's like having 3 kids in college at the same time.
And then after the after the capital financing tab is the finance graph, so it basically translates our debt into graph form. So everything based on this little chart down here, so our existing debt is in black, and then any new issuances that haven't happened yet, so fiscal year 27 is on top of that. Anything in this checkered is cash contribution to get to our debt service level. So this target line is 7%. And then when we have a large project, we increase it to 8%. So this just shows if our outlying debt is within our policy or not. So these lines are the policy, and then the debt being marked on top of each other is how we can just visually see, the amount of debt that's stacking up compared to where our policy line
Where is
is.
the Squadron project in there?
It's in black.
No, that is black is our existing debt.
Is that
Oh,
the
Squadron,
purple
I'm
one,
sorry.
the large issuance?
I don't know if I put Squadron in there. 2036.
You had large project number 1 and 2, so I didn't know if that was that.
Might be 2030, hold on. $2036 and 2030.
I see 31 and 31.
Yeah, I just might not have changed the labels. So they are here. So it's this like yellowish mustard.
So when is that project approved? If that's in Hitzing and 38,
So
3 years earlier?
So under this scenario, I had it in my notes. Hold on one second. So this puts it on the plan in 2032 is where it would show on the capital plan, and then the impact years would be fiscal year 36 and fiscal year 37. And
But to the
then,
extent we can build cash for capital capacity, that can then be used to help during those spikes if you want, and it can also be paying for capital. I mean, that's why this is so critical, because Squadron is gonna eat up everything. So we have to have some way to pay for other stuff.
so then just in this example specifically, I just took that down payment that Lisa mentioned earlier. I didn't have the 3.5 million, so I just did it based on what a large increase in taxes would be. So this one's 4.5. I added 1.5 million and then added $1 million in 2033. So our tax goes back down to the 2%, but you have that large payment. If I were to change it to that 3.5 that she mentioned and took this out, your large increase would be 6%.
Now, but look at what happens the next year. Can you go back up? So then the next year, you could keep that 3.5 million, right? And just do cash.
Yes.
You could just do cash for capital going forward. Why does it, okay, and you're still at 2.5, and now you can suddenly pay for more capital. So your assets are not depreciating and crumbling.
I think it's when you get.
And then you have that all the way through, and it becomes a policy tool for the Board of Selectmen and the Board of Finance, if we need to do mill rate mediation in there. It then enables you to do that.
Yeah, so you're basically taking your debt hit early, so then in the out years you're back to quote unquote normal.
The other thing I think I wanted us to think about is when, and I don't know the answer to this, so I'm not saying this is what we should do, but we are seeing budgets fail over and over when they have spread the pain over multiple years. Farmington and Simsbury did not. They said, let's take the hit in the year. It's bad, it's gonna be bad. We got one bad year, and then we need to make sure that we have lower taxes in all the years that follow. The other one said, no, we're just gonna do 5, 5, 5. And it was bad. And those budgets all failed. So one thing to think about is timing it with the revow. You know, the year of the revow, it's gonna go up, nothing we can do about it. We're gonna do squadron, it's gonna be the one-time hit, it's bad, don't get me wrong.
So
And then, but mill rate is coming down, and then once the mill rate comes down, the base is up, and then after that, if you can then return to sort of a normal tax increase. Now, one thing, you know, we're 2% we chose as our target, but it's now on a higher base. Should it still be 2% or should it be down to 1.5? Those are the other things in terms of taxes, because we're collecting more.
and can we not cut expenses?
Yes.
Yeah, like figure out a way to cut expenses with Board of Education. Your budget is much smaller.
Well, that's why I wasn't jumping on the need to increase of expenses above the 3%, even though I agree with the chair, it could be 4, it could be more. But we always have the ability to make government more efficient.
Yeah.
And this model doesn't factor that in, which obviously we will continue to do that. I think Amy's right to not increase the expenses, hold the increase at 3. The burden's on management to make sure that we hit that 3. And so you're working to make sure your tax increase is 2 or less. And you're obviously working to make sure that your increase on the expense side is 3 or less. And that's just what it is.
You know, because this takes me back to an article that I read in the Wall Street Journal during the budget process where, you know, the referendums in Massachusetts were failing because
Sure.
the electorate wanted more efficient government and more
Right.
cost savings. And we could get ahead of that game,
We
start
are,
looking at it right away.
we already are. I think that's, stay
And
tuned.
then we talked about it too, in one of these meetings where we thought, why don't we seriously look into that? Because if there's going to be,
We're working right now today on 3 big efficiencies that are not ready for prime time yet, but we're very proud of the work that we're doing. And I think sometimes there's criticism that, you know, folks don't know we're working on it, but there's also, it's very true that an idea, a concept has a point of critical mass where you bring it to leadership, and it's not there yet. But the other side of that coin, Lily, is that when we do bring it forward, understand that we've been working on it for a while before we bring it forward, right? So the good news is that that's why I'm calm, is that there's low hanging fruit, particularly when you talk about the Board of Education and shared services and all of that, right? We there's a lot of room to do a lot of cool things.
because to the point of some of our voters who, you know, their tax bill went up 40%, some houses went up 50%.
Right.
And you know,
And the problem
and
with
and it's the same house.
right, the problem with the reval, I mean, we don't have a crystal ball, but I think to Bert and Lisa's point, the lower value properties are more likely to take a higher percentage relative, so it's a disparate impact on the I won't say poorer, but the less
Lower
expensive
value
homes,
Lower
right?
valued homes, yeah.
So, you know, a $1.2 million house might not see the percentage increase because values at that level of the market are not increasing. And so the risk of this, and I was amazed when Amy told me what Francine said, to 25%. That's a shocking increase in my opinion.
Yeah.
And when you jigger that with a disparate impact on property values, say under 600, the impact, and then roll in the what we've talked about the last 3 meetings, commercial value dropping and shifting to residential, I think it's a problem.
Amy, can you go
Let's
back
get that
down?
bandwidth in as soon as possible.
It's a bandwidth problem.
To the bottom of the page. The other thing I just want to draw people's attention to is you see, look at the tax home impact. Those are still big numbers. You know, if you do $250 a year, 4 years, your taxes are going up $1,000. Will our residents support that? So that's a big unknown, and we don't know that answer. Amy, the one thing I don't know if you can work into the model, because I think this is really excellent. I've been playing it, although you'll have to work with me on the computer because I'm getting caught in the loop. But is there any way to add the total debt in there?
What do you mean the total debt?
Like how much do we owe? Total debt.
So it's on this tab, if you go to our existing debt, and then you have it by year. So our total that we still need to pay is just shy of 67.9.
How what?
67,900,000.
Where are you seeing that?
That's at the
At
bottom there.
right.
Why am I not seeing, can you show me the 67 million?
It's right.
It's right here.
You see where the cursor is
I
pointing?
can't make it bigger, it's not part of the worksheet.
Select all those numbers, you get the total in the lower right.
Here, you know what, I'll just do this, hold on.
Some all,
Yeah,
but that includes interest, Chair.
yes.
Well, that's what the debt service is.
Well, It's
Oh,
not,
yeah,
it's
no,
not
no.
our debt technically.
Oh, no, so we do need to show, is there a way to calculate total debt? Well, isn't that, why doesn't debt service count on debt? It's what's owed. Interest is what's owed.
It's what's
Does.
owed,
Goes through
but
the
it's not our
P&L.
debt at any particular time. Today our debt is X.
No, it's
Imagine
our
if you-
debt, cause like when we borrowed 68, the total debt was 95 million.
Right, but
But-
it's not the amount of the debt on a given
Today.
day.
Right,
Right, debt is debt today.
If
Yeah,
you
yeah.
paid it off
Debt
today,
service is based on the amortization.
Right.
I mean, obviously, many of our issuances you can't redeem within that 7 years, and some of them might have other redemption limitations, but if you could pay it off, it wouldn't be 67, it would be whatever the other total is.
But I guess the thing that leads to the second question, and I again look to Amy and Mark and I guess CTOPM. What benchmark should we be looking at? Like how much debt per capita do we have and how does that compare to our neighbors? How much debt to the grand list? What are the
I think we can get that
benchmarks?
from Barry.
Okay, that'd be great. And how that changes over time. And then the last thing, if debt service is 5 million, what does that translate to?
To the average property owner.
Yeah,
We can get that for you,
I think
but it's
those
4.7 million.
4.7. Well, no, if we do level principal, it's 5.7. Right.
But only for a year.
But is that what we're gonna do?
I think Amy is right to do level principal. Because then you get it tapers off and you can fill it with new project, it enables you continued investment.
Impact on the average property.
Reduces the total.
Oh, total debt.
Oh, right, the level payment was the lower. Was the
the
one that
lower debt
was,
service,
yeah, was
but at the
but
beginning.
total,
Debt was more. Okay. Do all those things, is there anything else we should be thinking about this is just the first look. We'll work with Amy and Barry as to what scenarios look like. But I think, for me, our priority is, I want less debt. I think I don't want people yelling at us 20 years from now, what were you thinking? You tied our hands. I think that there should be some skin in the game when people approve it, and it should be tied to your point, Mark, what is the debt service that you're gonna be carrying for the next 20 years? There should be some commitment there, just like a down payment on a house for the same reason. What that is, I don't know.
yeah, that's the question,
Yeah.
is what should that number be? Or what
Or should
should the methodology be, like
Or-
what should the philosophy be?
Yeah, or at least we should consider that as part of our, as we're considering how to fund it. And then to Amy's point, do we use capital reserves to reduce the initial borrowing amount versus using it to smooth some of the peaks in the future? And what does that do to total amount of debt? And what is the best use of those reserves, depending on the priorities that you want to pursue. And I think you could do it both ways, we've done it both ways, but those are part of the evaluations we should be making. And then to Mark's final point, and how are we gonna take care of everything else? Do we have a plan to take care of all the other stuff that, other than Squadron?
It's like 4 at the beginning.
I was just asking Amy what's left in capital reserves right now, which is a number that
5 million, you had it,
it's 5 million.
on an early one, you had a tab on capital reserves.
Yeah, so it's 3.4 without this year's contribution. I don't know what point in time that was during the budget process, I'll double check, but it's
You
about
have unassigned at
3.4.
4.9.
Yeah, so it's 4.9 as of the end of 6/30. Oh, that's my estimate was at the end of
26.
26. Oh, no, that's right. So that was the end of 26, and then I think we committed 1.5 in 27, but I just need to make sure.
Oh, okay.
So it's 5 million including,
That'd be less, 5 million minus 1.5.
Okay.
So 3.5. But then we're gonna increase 2 point whatever in October.
Yeah.
So it'd be a net increase, it'll be a little over 5. And then Amy, you did nice modeling as to what you thought the contributions were gonna be, right? Somewhere I saw that, maybe not here.
For the contribution to the
Yeah.
capital reserve fund, yeah, so I just have them here in this column. So I mean, I guess I didn't go through this tab, so our capital reserve fund as of the end of 6/30, what I think our contribution is gonna be, that'll be updated as we do actual year end. Any planned use of capital reserve, and then this just takes into account one scenario that I had done previously where we're adding the tax collection or we're adding a cash for capital and then we're using, say, 2 million. And I think it was brought into how we're developing the cash for capital. I took it out of this model just because of the tax increase from reval. But in one of the prior models that I had sent when I sent out the packet, you can see that there was a strategy for cash for capital, and that involved using the capital reserves. And then your cash for capital number was 2.5 based on what we typically need according to our plans with a 3% inflation. So that's what this is.
So you think 2.5 is reasonable?
2.5 is what has been on the CNR plan like consistently that department heads need from year to year.
that was million though,
2.5 million, not percent.
not percent of the
Okay.
budget.
No, it's 2.5 million and then a 3% increase for like inflationary costs.
What is
each year.
2.5
Does the 2.5 include
what
the
is
4,600?
2.5 million of the current budget as a percent?
Of the total budget?
5.
How do you do that so fast?
You think of the town
Four and a
budget.
half.
So maybe
Okay.
our
Worry about
target
his
is,
budget.
maybe
Not
the
yet,
target
anyway.
we'll use is 2% then, Amy, right? Instead of 2.5?
Yeah, that's fine.
Okay. And you're comfortable that number's right? Okay. So
I
then
looked
it's
at all
the 2% target, everyone comfortable with that?
Yeah.
Alright, so we kinda have like crazily agreement, do we have all that?
It's extraordinary, Chair. Love it. Good job.
Well, likewise, I
Very
mean, in talking with you, we tried to understand what your
I think you
concerns were and incorporate them
captured the big lift. Good job.
by everyone. And I mean, this was based on months of work by staff and it wasn't any one person's work. It was just pulling together what people have been saying for the last probably 2 years. And trying to articulate it and make sure we're all in consensus. Cause sometimes one of the things I've found, especially having done this for 17 years, is we use different names for different things and not always consistently. So one thing we can work on is trying being a little more consistent.
Especially for those of us who are so new that we look at this and we're going, is this supposed to be that?
Like sewer, WPCA, right? We should pick one and stick with it, cause it does get a little
Took me a
confusing.
year to learn all the acronyms.
Right, exactly.
We need a glossary list, Mark.
We have
I
one.
thought it was a traditional payback and then learned that, as we now know, it's pre-funded.
So the best person for the list of the glossary list is Mr. Franklin.
That's
What's-
right.
And it's
That's
also in the audit. I mean, we should probably use the terms that the audit uses.
Yeah. And we'll ask
Consistently.
Franklin to just make a template for all of us, put it on our refrigerators.
He's a good man.
Speaking of which, I'll reach out to him to get the annual report
Yeah.
organized.
Okay. Let's continue on. Wait, I forgot to do something. We were gonna appoint. Where did I forget that?
What was this?
Oh, are we done with capital? For now?
For
I mean,
now.
it's obviously gonna be, we have this is crazy, but we seem to have consistent agreement.
I would quit while I
Okay.
was ahead.
Yes, exactly.
Alright, so yeah, stop now.
I just emailed you the instructions on how to get the circular.
Okay, great, thank you. revaluation selection, Mark had mentioned he would like a member from this committee to help with the selection of the revaluation. Mark or Amy, could you please recirculate the assessor audit to, cause I don't think the new members have ever seen it, just to the full board again, get familiar with it. My recommendation is we just appoint one and then have an alternate and then I'll be the third if nobody can make it.
What does this
I
person do?
nominate Art.
No, what does this person do?
So they're gonna they go out to RFP, they bring in people, they interview them. And you pick, it's a very important position because getting the assessments right really impacts our residents. And we wanna make sure that we're meeting national standards and we have a path to get to national standards and we wanna be there.
And
So-
we're gonna need to defend it a lot.
Yeah, we need to be able, and our residents deserve to have the right assessment. We wanna make sure that it's accurate because that accuracy is fairness.
And when does this begin?
So I don't know.
Francine's drafting the RFP, so it should be going out within the next few weeks. So we probably typically give them about a month to respond, and then a couple weeks after that, we'll schedule the interviews.
So the first question is who would like to do this? I'm gonna be a grandma in September. I'm not gonna have a lot of time in September, so I do not wanna do this, but if there's someone who can step up and do that, I would be greatly appreciative.
I would love to, but I'm on vacancy. Is that going to be a problem?
No.
That's good.
No, this only meets a few times, right? You do the candidates.
It's just a 1-day
Yeah.
interview.
So it's a 1-day thing?
Yeah, we'll have
Well,
everybody come in.
it's a fair amount of reading. If you get 3 or 4 proposals, it could
Yeah.
take a few hours.
Yeah.
Okay, the interviews are 1 day.
Yeah.
For reading the proposals, I can't promise.
Anyone else wants it, I'll take
We'd
it.
love to have.
Does someone wanna be an alternate?
I'll be an alternate.
Yay!
Oh, man.
And I'll fill in I'll be the third alternate if nobody can make it.
No, you're gonna be a grandma. You
But I'm
need
not
to find
but I'm not
someone
doing
else.
it in September. If it's in September, I'm out. Bert, you'll be the third alternate.
Be Mike's alternate.
Mike, you'll be the third. All right, thank you.
Yeah.
Mike will be third,
It's a dream
Bert fourth,
team.
and I'll be last. Okay. May I have a motion to do that? Lalitha, Regina.
I nominate Dr. Shivaswamy to be our representative for the project of selecting the revaluation authority.
With alternates being,
With the alternates being in order of selection, Regina Pinn, Mike Doyle. I'm not sticking Art, and I'll be and myself last.
great.
Second.
All those in favor?
Aye.
Aye, okay, great. And Mark, thank
I
you
abstain.
for circulating the
We'll get it around. Thank you, Chair.
okay. We have the policy review. Oh, my goodness.
Yeah.
Okay, those are quick, I think,
Will they be quick?
yes.
We're happy to defer them to the next meeting if you want, Chair. There's
It
no
would be an
rush.
easy deferral.
It's
All right,
only
people comfortable with that?
75 pages.
Yeah,
Yes.
I mean,
because
yeah, it's typically what we do
only
anyways,
40.
we put
Okay.
them in and then everybody has to,
Got a chance to look at it.
yeah.
Okay, well, so may I have a motion to
Is-
table this to the August meeting?
Yes,
So
but
moved.
just a question, is it usually when I'm used to people reviewing a big document like that, there's like a Word document with track changes that kind of lets the discussion be
Yeah, I sent it
consolidated?
with the packet. There's a Word document
There is a
that
Word
has
doc,
all
okay.
of the policies in it, yeah.
Alright,
If you don't want me to resend it, just let me know.
see if I can actually use my computer, but then I'll send
We
it.
don't
Alright,
have
thank
a
you.
shared document that people can comment on and it's in one place. Do
That'd
we
be
have?
amazing.
That'd be
No,
so
I
much
mean, Board of
better.
Ed does, cause they have Google, but we
We
don't.
could just have comments
Yeah, if we could just,
and not talk about all of them, they'd just be in the.
is it possible, we should be okay to put it on a Google Drive.
I mean, yeah, you tell me what to do, I'll do it.
Why don't we do shared? Because there are 6 of us and there are lots of pages. Don't you think?
Does
What do you
everybody
think,
have
Jen?
Google though?
I do.
I do.
What was the question?
Does everybody have Google?
I do not. But
Well,
but Lalitha will get me on Google.
Yeah, 'cause
Well, so.
Mike will get you on Google. We have Mike.
us will.
Okay, great.
That might make it, let us have more substantive, like, instead of reading off all of our details, we could just pull it up,
Yeah.
scroll through it.
Mhm.
There's like a next button when there's changes.
Google Docs and somehow I'm able to
Okay,
do
the only thing I will say is we cannot comment, we can't do a meeting on that, so you can put your comments in there, but the discussion of them has to be done publicly.
Yeah.
So that we
Yeah.
can see all the comments in one place, but there cannot be any
That's fine,
discussion,
but
so
I
we just need to
think there's some
comply.
benefit to not having to like say the edits. Like the edits are up there and let's talk about if they're valuable edits or not.
And you go through
And you
each
just go through
page
Perfect.
and
And if it's in
it'll be
red, we
on-
talk about it. If it's not in red, we're not talking about it.
So the ones Amy put in are in red that we're changing, but Amy, you were gonna make a few changes based on some of the things we just found there, so you could add
Yeah, I
those for
haven't made any of my own proposed changes. The page 31 for the capital planning and financing came from you and Bert. And then the fund balance policy update on pages 42 and 43 came from Lockton. I haven't done any of my own edits yet, so
Okay, but the ones what we just talked about today that Regina pointed out.
Yep.
Okay, cool.
I have those on my
So we'll
list.
do those for Thursday, August, so that makes sense, okay.
we still need the motion to move it.
May I have a motion to table policy review to the August 2026 meeting?
So moved.
Seconded.
All those in favor?
Aye.
Aye. We will table those and review them in August, all right? We have the minutes, I submitted minutes in advance, the big change I did was I just moved,
We saw.
all right. Anyone wanna approve
I
the
move to
minute?
approve the June 16th, 2026 minutes as amended.
Seconded. So moved.
Okay, any further discussion? All in favor, please say aye.
Aye.
And I
Motion
abstain because I wasn't there.
Okay, we have enough to do that, great. Mike, did you vote for that?
He
I
did.
did.
Okay, thank you. We also have, we had asked as follow-up from the last meeting, Mark, thank you for getting us the P card, or through Amy, the P card, 3-minute example, I think Amy sent that actually, not Mark. It's been in the news, I just want to re-emphasize for the public, neither Mark nor the first select woman has P cards. All right, thank you for that. And I think that's it. Is that it?
I have one minor thing, just because you mentioned September. I'm not gonna be in state on the 9/15, and if you're gonna be grandma that month, I just wanted to heads up, we may have to figure out some foreign things.
Okay, so if anyone other than Regina and I are not there for September, we're gonna have to reschedule that meeting.
So just wanted
Okay.
to throw that out there.
Okay, should I keep an eye on that?
Yes, we'll
Because
do a quorum check as we get closer, whether we need to I mean, we haven't really been able to cancel a meeting in the summer, so maybe cancel the September meeting, depending on the needs of the town. That would be, and that'd give Amy a chance to do the closeout with the auditor anyway, unless something comes up. That's one possibility, so just keep September being flexible. That may I have a motion to adjourn.
So moved.
Seconded.
Any further discussion?
I'm in favor.
Yes.
Kidding.
Oh.
I've been wanting to do that for 30 years.
Okay, all in favor, please say aye.
Aye.
All right,
Before
thank
he
you
says it.
everyone, great discussion.
For over 40 years, SCM has been the voice of our town.
bringing us together through local programming,
Education and live broadcasts.
SEM isn't just about television.
It's about empowering our community.
ensuring our voices are heard during government meetings,
and celebrating milestones
like our high school graduations.
But today, SEM faces a challenge.
Our funding structure is based on television subscriptions.
And it's no secret, people have been cutting the cord.
With a shift to internet-only subscriptions,
SEM receives less revenue,
even though all our programming is freely available online.
We need your support.
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 Your donation can make a difference.
It will ensure that SCM remains open,
continues to educate our youth,
and keeps our community informed.
Thanks to SEM, I've been honing my creative skills, helping me work towards my college degree.
SCM is crucial for keeping our community connected.
SCM isn't just here to broadcast local events. They're actually preserving Simsbury's history.
Join us.
Join us in preserving Simsbury's voice.
Simsbury's voice.
Together we can ensure that SCM continues to thrive
for generations to come.
Visit our website
Or scan the QR code on your screen to make your donation.
Every contribution
counts.
Thank you for supporting Simsbury Community Media,
where your town,
Your schools,
And your government
come together.